And started today. Welcome everybody to the UK's Investor Guide to Picking Stocks in Volatile Markets. A very grand title for a very important topic. My name is Simon Campbell. I am the founder of the IX Investor Show, round the clock trader events, various other trader and investor event activities. And a lot of you here will be familiar with the events, so I keep looking over at all the questions coming in, so that's great. Good, a lot of people already in the room, which is great. Welcome to everybody here. So this event that you're part of today is a pilot event. It's the first of many events that we hope to hold in collaboration with Stockomendation, who of course are the company behind the UK Share Pickers game, which is also being led by Alpesh Patel. Alpesh Patel, very familiar to those of you who've been on our events. Alpesh and I have known each other some years, it could be said. And I'm pleased that he's here taking part in the event today. So what we've done is we've gone out to everybody's networks and we've invited people that are already involved in the game. And if you're not already involved in the UK share picking game, it's great fun. And there's cash prizes to be won. It's all demo mode, of course. You're not actually risking anything at all, but you're learning a lot about different strategies and methodologies, how the experts are helping you to get into good stocks ahead of time as well. The reason we have done this event is because it's always interesting to hear what experts are doing. This is one of the philosophy of the Stockomendation service. And we've invited everybody, one or two of our favourite speakers, to take part today to tell you a little bit about the way that they invest. Everybody has a slightly different system, uses different tools and resources, so it's just good to always keep in check, get some up-to-date market commentary. Of course, this year is a difficult year, I would say, for the markets. We're going through different times for stocks, and oil, of course, is very on everybody's lips. Cryptocurrencies are looking at a bit of a drawdown for now. So it's everything's in the balance. It feels very strange territory, I would say, with the war in Ukraine and the cost of living crisis affecting everybody. So that's why we're here. We're here to help you. We want you to learn, and I'd like you to use the facility of this live event. We're going to be live for the next 3 hours. You've got a chat box there. We've got direct access to myself, to the speakers. So even if it's something that we're not covering on the slides or looking at on the platform, please don't hesitate to just ask us a question. Anything at all about stocks that you might be in already or worried about, we can ask one of our experts to have a look at the chart and have a look at the analysis and give you some feedback on that. So please do use us in that way. We've got a lineup of speakers that I'll just quickly go through, but while I'm doing that, can I ask you just to give us a quick technical check? Use the chat box just to write a little hello or a yes or something, and that will let me know that we can hear and see okay, and everybody's, all the technology is working okay. That's great. Oh, I can see all coming back in already, which is great. So let's look ahead to the next few hours. Alpesh Patel, OBE, hedge fund manager, and founder of Campaign for a Million. I'll just tell you a bit more about that when I get started. He's going to take us through our first session. He has been heavily involved in the stock market share picking game, and a lot of interesting information comes out of that. So he'll tell you all about that. He's going to give you a market overview as well, tell you which sectors are worth looking at the moment. Following Alpesh, Paul Roberts, founder behind Stockomendation, is coming to tell you a little bit more about the Stocko service itself and how it works and how it integrates with the share picking game. So that's worth looking at. And he's going to be talking about the benefits of using experts in your investing strategies. It's not just about saving time, although it can help to save time, but it has been proven to be a worthwhile strategy to follow the billionaire investors, follow the people that know what they're doing. It can often help, but you do need to still do your own research and just back up this with your own education research. worthwhile just popping a disclaimer in here as well to say that this is an educational event. We will be talking about stocks, live market stocks throughout it. Nothing that we do talk about, though, is to be considered as a solicitation to invest in a stock. It's educational only. We don't know who you are. We haven't done any financial know your customer checks. So please don't rush off and buy stocks on the back of something you hear today. We're trying to give you the tools so that you can make the best informed decisions yourself. So Alpesh and Paul will take us through the next 35-40 minutes. And then I'm pleased to say David Paul will be joining us. David is the founder of VectorVest in the UK, a system that I know very well because I did work with the company several years ago myself. He will be explaining his methodology for looking for stocks, particularly stocks that can outperform inflation, which of course is very important for today's markets. Following David, Zahir Anwari comes from Sublime Trading. Zahir has put together his own stock watch list in a format that we can review, and he's going to be explaining what led him to put these stocks into his watch list, what stocks are in his portfolio at the moment, and how he uses the charts and trend spotting strategies to keep him ahead of the market. Finally, Stephen Clapham is the founder of Behind the Balance Sheet, and many years in the city. Stephen will be taking a fundamental approach to investing, but particularly looking at growth stocks. Of course, growth stocks may not be on everybody's mind at the moment. Lots of big surprises over the last 6 months, but he'll be telling us about which growth stocks he's interested in and what's next for that sector. So moving ahead, there we are. I should have turned onto that slide a second ago so you could actually read it as I was chatting through. Thank you for letting me know all about the technology. Everything seems to be working good with everybody. Our first question from Ryan: what's happened to Amazon share price and how does the split work? There we are. Alpesh, you might want to comment on that as we get started. So let's first of all go across to our first speaker, Alpesh Patel, and I will make Alpesh the presenter now, and like magic we should be able to.
Hi Simon, you should be able to hear me. I'm going to see if I can put my camera on. That doesn't always work.
Okay.
It's not even always good for the audience.
We didn't talk about whether we were using cameras or not, so sorry for that. Sprung it on you.
It's on my big belly. You need it on. I've got 2 cameras, you see. But he's gonna...
Why wouldn't you?
Well, obviously, when you're an egomaniac, why wouldn't you? Okay, here we go. Nobody needs to see that.
Just
good job where I'm wearing trousers today. Hey Simon, not like last time you and I were talking. And I'm going to share my screen as well. So, which is the important part because there's a lot of data. People want to keep their phones on. To have a look at this, I'm going to find the right screen to share with you. Give me a second, because I'm afraid there's more than one screen. Here we go.
And you're on the Amazon chart.
You're on the you were on the Amazon chart. I'm going to bring that up shortly. But first, what I want to do is show you this. So, right now, hopefully, you should be able to see the share picking game. Is that right? And you might even be able to see me. There you go.
See you as well. Fantastic. Hi, Alpesh. Great. Okay, so yes, I can see the screen. I can see Alpesh's share picking game data. Everybody else, just let us know you're looking at Alpesh and can see the right slide. That's fantastic. Okay, so Alpesh, tell us a little bit. I didn't talk too much about the share picking game. This is something that some people will know about on here.
Yes,
other people will know anything about it.
Yeah, Paul invented. There's about £150,000 in prizes, everything from weekly prizes to monthly, and so on. And it's supposed to help people, well, and it does provide a safe environment which to learn about investing in a fun way. You know, I've had this campaign to teach 1 million people how to be better investors, and so this really dovetails really nicely into that. And Paul is probably one of the most enthusiastic people I know who's set this up, and and the tech, behind the scenes allows me to share data with people each week in terms of what's working, what isn't, and it gives you great insights. But like I said, more importantly, there's no downside risk because it's a game. You can get your family on it, get your kids on it, and all the rest of it. And there's only upside because if you win and you learn a lot, and you win something, you might make a dent into that 150K. There's a positive without any of the downside, because as we know, and certainly this year, we know that the markets have been bloody difficult. So what a great time to have a game where you're not doing it for real, and time to sort of take some time out. And I put together a bunch of slides to take people through it. Actually, if that's okay. So you let me know when you want me to kick off.
I'll step back for the moment and hand over to you, and I'll be interested to see some of this information.
Yeah, perfect. And I just want to make sure that everyone can see the slide. So you should be able to see the slide, because I'm not used to this webinar format. I use a different tool. So sometimes, especially as I get older, I'm getting more befuddled, I find, Simon. I'm getting more like you. Right. So this is the total number of picks so far. I'm going to share some of the data. I'm going to show you what's important out of this, and what might give us some stock ideas. And I'm going to share some of the stock ideas that I've got and where I think things are going. And also, I'm going to let you know how I think you could win some of the prizes, how you could game the game. Many years ago, our mutual friend Tom Winifrith used to host Show Me the Money. And out of, I think it was about 42 pickers in one of the seasons, I came top. The reason was it was a game and you had to pick a stock, and I gamed the game. I sort of worked out, well, okay, if it's a competition, it's different to what you might do for your SIP and ISA. And I'm going to share what I did to win that in Show Me the Money, on how you might become a winner on this. It's fun and you might get some prize. But look, if it's not the people watching this, somebody else is going to win it, so you might as well be one of those. So I'm going to share those insights with you in a second, and I put that together in the slides. So anyway, total picks, buy picks. Look, the majority will buy picks. That's just human nature. That's how people are. Maybe they also think that we've hit the bottom of the market, and I'll talk about that in a second. Sell picks on average have better performance. It's marginal, but it's the margins that make a difference. Okay, well, that's giving us a bit of information, but we don't care about average performance. We never have. We want to average. We actually need to know what's doing well. So the most picked companies, percentage of all picks, BP, Rolls-Royce, Lloyds Banking Group. Well, that's probably similar to many of the brokers. What's interesting here is I'm going to show you that the big cap names and the names which have name recognition are often not the biggest movers, and I'll share some data that I've got from the markets on that. There's also been academic research to show people tend to pick stocks which are names they can recognize, but that's often not what's going to give you the best performance. And don't forget, best performance for a SIP is completely different for a game. So similarly for a game, you might want to, and this is one thing we want to do, is encourage people to look outside the usual stuff, as well. So most sold, Ocado, Boohoo, Aston Martin. Now, there'll be some people who just tear their hair out and go, what are you thinking? Why the hell would you sell those? Why would you buy those? Look, calm down, all right? You never want to get too overexcited with the markets, because you're selling yourself on a position if you are. And this is just, as I say, the raw data. Most sold sectors, retail and automobiles, okay, which suffered from income reduction or slowdown, possibly increased cost in production. There's all sorts of reasons we could give ex post facto why something's happened. But again, that data is useful, but it doesn't get me truly excited. I think it's incredibly useful. It's important, but I'll tell you what gets me a bit more excited. I want to know, what are people picking and who's doing well, and if there's some outliers, and what are those outliers doing? It could be that the outlier is just lucky week after week after week. Don't forget, this is 19th of April to the 9th of June. So quite a few weeks to be lucky. Maybe they had one lucky week and it averaged out everything else. Well, we can drill down into that. So these players, player number one, I think his real name's Gordon, G. Gecko of New York. Greed is good. Average performance 1.51%. He might say, well, it's not great. Actually, in this market, not bad at all, given that the FTSE All Share was down. So they've gone against the grain of the market. 26 picks, 21 for the finance guru, Ebo Elzy, 49 picks. Okay, what does that tell you? Well, it's not that they had a one-hit wonder. That's important, because if somebody just picked one, what's the point of putting them in the data? All of these three players have a hit rate over 55%. In other words, they're more often right than wrong. So something happening there. These players are able to generate stable profits during volatile last few months, making them good candidates to add to watch list. Now, this is the important bit. You can log in, it's all free. You can log in and see what's in their portfolios. Okay, and unlike sort of copy trading where it's real live cash, this isn't real live cash. I mean, I would never want to copy somebody necessarily for real live cash and just entrust all my money and say, yeah, whatever you do, I'll just buy it for me as well, mate. I mean, I'm neither rich or stupid enough to do either of those two things. You know, just say, yeah. But what this allows you to do is just watch it, and then you put it in to the mosaic of information you'll have in your head to say, oh, actually, you know what? All three of these have got these stocks. I mean, I'll do my weekly updates and I'll tell you how to get those as well. As I said, it's all completely free. Who are the worst players? I don't know. We've not done a name and shame, but we can in future if you wish. I'll ask Paul to give me the data on, I don't know, naming and shaming people who are the absolute worst. But I don't know if there's a benefit of that other than Schadenfreude, and that's not a good emotion to have in any event. All data correct as of 9 AM on 9th of June. So, okay, that's fine. There's some big names out there. And most importantly, you can go on there and look at things. What might we want to look at? Well, we know energy stocks have been doing well, particularly in the US. This is a UK stock game. And we know similarly UK stocks have done well so far this year. But we're talking about a game where it's week to week performance. And that'll appeal more to the traders. It might appeal also to the investors who are thinking, well, you know what? A 12-month investment is made up of weekly picks as well. Oh, by the way, I've got some audience questions which I'll answer and I'll put into this. Alphabet worth buying post share split? Do stocks continue after a share split? I wonder if they meant Amazon. Have Alphabet had a share split? I know Amazon, of course, have, but have Alphabet recently? I don't think so. FTSE 350 best and worst. So we also know that in the space of 5 trading days, you can get some of these massive gains. Okay, these were the best 5 trading day performances out of the FTSE 350. Now that's big cap. And what I might suggest in a game is you don't want to go for big caps, and I'll show you why in the next slide. By the way, speaking of worst performers, and you're asking worst performers, the worst performers will be people who put their money into Wizz Air, B&M, National Express, Pantheon, Royal Mail, EasyJet, and the like. Okay, I mean, EasyJet and Wizz Air, I wouldn't even want to book flights for. I would not want to be booking flights with them even before all of this. Anyway, those are a bit more easy to pick. But it's a game. We need a bit more than this. And also, that's hindsight. That was the last 5 trading days. Is there a correlation between the preceding 5 trading days? In other words, and here's another insight. What if we went for the bigger companies? And what if we went for companies which this week, this past 5 trading days were the highest performers? Are they likely to be good performers? In other words, do trends persist? And I'll answer that in a second. And what I suggest you should do is look at the smaller cap companies overall, okay? And the reason for that is the gains tend to be bigger. They're harder to find. So that's not necessarily going to help you in that you're fishing in a bigger pool, but certainly I'd say greater chances of getting it right than just the FTSE 350 types. And you might say, well, I know more about the FTSE 350 types. I suspect you don't, because you can get as much information about smaller companies as you can about the bigger ones. It's just the bigger ones make the headlines on the BBC and CNBC and whatever. So let's look at some of these small. Now, I have, out of that, who have I heard of? I don't know. Some of you guys will be far cleverer. I mean, obviously, ADVFN I've heard of. Who else have I heard of? None of them, I don't think. I don't think so. Now, some of you will be absolute experts in this, and this is another good thing with a game like this. Some people are just absolute experts in small cap companies or micro cap companies or whatever. Okay, so you know, Morsis Club PLC. I don't know who the hell they are. I should know. Of course, I should know the ins and outs of all of this, but I don't. Block Energy, I can sort of see it's an energy company. But you know, interesting that it's the smaller caps. Well, is it interesting? Well, we should know that anyway. Smaller caps tend to do better. But again, that doesn't give me an ability to pick. So I know I need to look at smaller caps if I want to win the game. what about this correlation then? What about the ones which in the week before this week did the best? Did they then in the past week also tend to do well? Well, actually, yeah, there seems to be some, this is not scientific, of course, because you've got to control for what the market's done as well, but there does seem to be some follow through. Morse's Club, for instance, did 61% in one week, and then the next week did 92%. So if you picked it, because it was one of the best performers, as part of your picks in the game, you wouldn't have done too badly. In fact, if you went and picked the top, what is that, 15, I think, stocks roughly, there on the 28th, well, on the 3rd of June, how many for that week had done the best, and you pick them going forward, well, in the last week, you would have actually had a pretty good return. And I would suggest you may well have beaten everybody else in the game. Okay, so that's definitely one way to look at it. Of course, this is momentum. It's small cap momentum. If you said to me, Alpesh, what are you thinking about picking for your SIP or your ISA or a Charles ISA? I certainly wouldn't be looking at small cap momentum. For a start, small cap, higher risk and volatility as a general rule. And momentum is only one tick box of many things I'd like to tick before I pick a company. Valuation is another, revenue growth is another. So it's a quick way of learning. Well, it's one way of learning that there's more to it than just small cap and momentum, but also if in a game, in a sandpit of a game where you're not risking live money, you start seeing the worst case scenarios, it's a lot better to do that in a safe environment than realize after the event, okay? So I wanted to share that with you as well. Just going to check for other questions. Oh, there's quite a few. Only goes the AIM 100, doesn't go low. No, you're right. Doesn't. And so what you can do is obviously pick off the list and remove the ones which aren't in there. Paddington's good as a short seller. That's good to know. That's good to know as well. So when you go on the game, you'll see who's doing well. There's actually teams as well. So do log in and have a look and look at the things on there. Okay.
This is
sorry, go ahead, Simon.
I should probably mention that one of the idiosyncrasies of the GoToWebinar is that when the questions come into me, then I repost them. I'm not sure if you see who the questioner is.
No, I don't see the question, I'm afraid. I only see
my name.
Audience question is all I see.
That's Paul that's posting these questions, Paul Roberts.
No, I figured because he'll have the data. He'll have the data at hand as well. And
Paddington's somebody a username. I'm getting not
yeah,
the Queen.
Good. Paddington as a short side has been amazing, especially after his visit with the Queen.
Yeah.
He's been really pumped. We'll do a bit more on the questions in a second. Some of the other stuff I want to share with you. Well, that's UK. You did ask me for more broadly, and given that we're looking at things on a daily, weekly, well, I thought I'd share JP Morgan's favorite stocks for June. Doesn't mean I necessarily like them. These are US. This is outside of the game then. And you can see Amazon's on there and a few others. I'm not necessarily endorsing any of these. I'm just sharing the data that I've got, some more data to share with you. And I've also got United Health. This is Wall Street's favorite Dow stocks. So again, broadening it out beyond the game. Once the game gives you the bug to invest more or just look at things, and we're Paul and I are looking at a US version of the game as well. So do sign up because you'll get notification when we launch the US version, which would include things like this. So Wall Street's favorite Dow stocks, buy rating percentage is upside to price target. If these are right and Wall Street is right, well, I don't mind 30% on Microsoft. I'll come to Microsoft in a second, and Amazon, I think I was asked about, and so on. You can take a picture of these guys if you don't have the chance. And we've mentioned the UK. Well, there's the UK and where the UK sits year to date and some of the big companies and which have performed well. Actually, who's done the best year to date? Some of the Canadians, as you'd expect, because of commodities and energy. Brazil, commodities and energy, Petrobras there you go, which, Simon, you won't remember this, but about 20 years ago, at one of your events at Olympia or something, I said, look, just buy the Petrobras ADRs. I used to bang on about people buying international stocks. And I think in the last 20 years, you would have done rather well. Anyway, that's the global markets and where we are. So I just wanted to put the UK in a context, which people do look at outside the UK, obviously. That's Microsoft. And Amazon's very similar to this. I've got Amazon on this, and it's almost identical to this, as you'd expect. So for this, you can read what I'm talking about, Amazon or any of the FANGs, you know, Apple, Amazon, Alphabet. Because a lot of people ask me about this, and you can see there's the downward trend, and it's been there for a while. And really, the question is, have we ended it? Is it finished? And my worry is this: you can see here what I'm circling, and I think you should be able to see it. That's the monthly MACD. It seems to be, sorry, that's the weekly MACD. It seems to be flattening. Okay, things are slowing down. I think it's sucking people into the market. The monthly is still not looking like it's turning. So I'd rather wait another week. Have we got a bottom? Well, again, the weekly stochastic and then above it, the monthly stochastic. It looks like there's a little bit of a bottom, and that's why you're seeing this flattening out and people being sucked into purchasing. If you're risk loving, this is how you make a decision. If you're risk loving, you might get in now into Microsoft. If you're risk neutral, you might say, well, you know, I was going to put £10,000 into Microsoft, I'll put a third in this month, a third next month, a third the month after. If you're risk averse, which I generally tend to be, then you'd probably say, I'll give it another week. I'll have a look at this again, and then I'll decide. And that's how I decide things. You know, simplify the decision-making process into different buckets, and I find that it just saves me a hell of a lot of time and avoids confusion. That's Microsoft. Amazon is almost identical. It's fallen further than Microsoft, but in terms of what the technicals look like, it's almost identical. Okay. Simon, I wanted to mention this. We're doing our summer school. People, please don't forget alphatrail.com/Spain. I'm going to go into the questions in the second. Paul's got some more updates, and you get a lot of free stuff there. And if you want to see my weekly updates, you can go there as well, and here to get a lot of free stuff and the links to the game. You'll see the link to the game on there. Well, when you go to that link, you'll see it.
We'll post links as well in the chat box here for anybody that's not already there. I can do that from here.
Yeah, right, what have we got? In the game, minus 37% of all UK share pickers, sorry, 37% of all UK share pickers were in positive territory, 78% outperformed. Now, that's interesting. Paul said 78% outperformed the markets. If 78% have outperformed the market, then what that's telling you is there is some valuable data in there, all other things being equal. So there's a lot of reasons to look at that. As I say, it's a lot of reasons to get that data, and it's an alternative data source than just, I mean, I've shown you this, and that's conventional, okay? It's the norm. But I think the more alternative sources of data that we have, there might be something in it to just give us, as well as all the other benefits, to give us a go on that, to give us something interesting. Other questions? Are there any questions I've missed so far? Let me know. Is there anything people want me to go over that they think I haven't gone over in enough detail? Top 3 players, by the way, were over 30% last week. Paul's just messaged, the top 3 players were up over 30% last week, and their picks will be on the game. But Paul, if you want to share any of the key names which helped them deliver those results, let me know.
Well,
yeah,
thank you, Alpesh. Well, just as we're heading into summer, what's your take on the markets? We're in unusual times with wars and things going on around the world. Are you cautious going into summer? Is it a time to stand back, sell in June and go away? Or
no, so we did some analysis of what happens if you actually buy in May for the subsequent 12 months. But what would you buy in May as opposed to sell in May? And we looked at the stocks, and this is for the analysis we did for the US markets. We looked at the stocks which were the top 8 best performers from January to May this year, and we went back every single year. And what would have happened if then in May you bought the top 8 performers and held them for the next 12 months? So if you did the exact opposite, and we were getting, there were some years where you were down. I think 2009 was a down year. I forget whether it was 8 or 9, which was the down year. It was sort of after the market had bottomed, the subsequent year was down, which is a bit weird. But other than that, you were getting things like 38% returns, some years even more. Now you might say, why 8? Why not 7, 9, not 5? Why not 10? Why not 11? We tried that. We tried that with different number combinations. You might say it's overfitting. You might say it's coincidence. You might say that, and statisticians will tell you there's not enough data in just 20 years worth. So I'm I'm not bullish, as it were. I'm not bearish going into summer, because it's a stock pickers market, and the ones that I picked fit that profile. So I put it on my Telegram channel and shared that a while ago. Again, the links are in the bio. I shared the ones that I picked on that strategy, because when I was looking at my normal value growth income, I was waiting. You saw the Microsoft stuff for my SIP and ISA. So instead, I did a special strategy, my special situations. So this is what a normal analysis for me would look like. It would be going through all of this and ticking every box on valuation, growth, cash flow, momentum, volatility, return, outperformance of the market, additional valuation factors, lower volatility, and making sure I've got all greens. I was just happy to wait in January, and then January went and February came, thinking I'd be buying in February. Didn't happen. Buying them up didn't happen. And the only thing that ended up happening was buying on the special situations, which were I'll dig those names up whilst you're talking in a second. They're in here somewhere. I sort of do so many updates each day, but it ended up being a bunch of stocks which fit what I've just told you. And do I think those will go up 38%? Well, they're up about 12% already. Which is ridiculous, but you know, and that was a special. So like I said, it's a stock pickers market, and you might not be able to use your normal strategy, or your normal strategies might keep you out of the market, and that's fine if they keep you out of the market. I'm in no rush. I just showed you, what did I show you? I showed you Microsoft. I'm not in a rush. I'll wait. I don't trade my investments, but when it looks like that, and I see the monthly momentum so strongly lower, then I'd rather just keep waiting. And I thought I'd be going in Jan. You know, you can see the dotted line there. I thought, oh yeah, Jan, normal, because obviously going up. Then it fell. I thought, oh, wait a week. Oh, not looking good. Oh, wait another week. Oh, still not looking good. And even when this was rising, I thought, hang on, that's still falling so sharply. I'll just wait. I think it's a bear trap. And indeed it was. So even with my investments, for the first time in, I don't know, 8 years, maybe less, 6 years, it has been worth timing the investment. Normally I wouldn't bother timing it. We're just like, well, because obviously the market was just bloody rising. Why wait? Just get the hell in there. But this time it's been worth even the quality companies waiting.
Yeah, but just one thing. When you refer to a stock pickers market a few times, for those that are new to investing, what is it you mean by that?
Yeah. So what I mean is everything isn't rising. So you see, even an idiot could do well over the last decade because everything wasn't rising. Sorry, everything was just constantly going up. You know, 70% of stocks are rising, 80% of stocks are rising. This year, only 25% so far, roughly as a rough measure in the US, I'm talking about the US markets, are up. Therefore, you had to pick to be in that category. So it's a bit harder. Now, if you're risk averse, you'll say, whoa, I think I'll just have a bank account and just keep my cash under the mattress. That's fine. If you're sensible, you'll say, well, actually, I'm going to have to do more due diligence and make sure I pick the right ones and tick more boxes. And that's what we always tick boxes. So even when the market was stupidly rising, or like now, it's not as easy, we're always ticking it's like due diligence for anything else, whether you're hiring somebody, whether you're marrying somebody, whether you're whatever, got to tick every single box and do tons of due diligence. If you just put your hand in a bowl and say, oh, well, hopefully it'll work out, it tends not to. You've got a lower probability of it working out, obviously, because you're leaving more to chance, and the more things you leave to chance, the lower the probability it's going to just work out by chance, by definition.
Typical number of stocks that you hold. This is always a question that comes up from people. To get that diversification, you always, theory suggests that you typically 10 or 15, or how many do you manage to?
Let me share something with you on that. So it used to be, I'm going to share some stuff. By the way, that's from Goldman Sachs, and how people are more, how funds are more using 12-month holding period and then review. Let me just show you where that is in terms of, see if I can get it over here. There it is. Okay, number of shares. Now, this is a simplified version. I've written about it in my books, and it used to be that you could diversify by sector, you could diversify by geography. Increasingly, in a globalized world, the markets are increasingly correlated. They're particularly correlated to the downside. So just when the markets are falling and you need diversification, which is another word for lack of correlation, the most, they're increasingly correlated when the markets are falling. So overall, the diversification benefits have been reduced as the markets become interconnected. If you don't believe me, when you look at extreme examples like COVID, well, Costco and Microsoft both fell. Well, wait a minute, Costco's a retailer which sells apples and stuff, and Microsoft's a software company. How the hell do they both get highly correlated and have a correlation of pretty much 1 to the downside, when before that they were going their merry different ways, depending on how the software market was doing, or corporate spending, and Costco, which is a retailer, how retail spending was going. So that diversification mantra we learned in the 80s or 90s, that's falling apart a lot. So people go, oh, it's okay, I've got things in different sectors and geographies, I'm diversified. No, they've got a perception they're diversified, but the data tells a different story. Okay, so bottom line, how many stocks should you have? I think bare minimum to remove company specific risk. By the way, if you want to remove market risk, you remove yourself from the market. What that means is if you don't want any risk from the stock market, then it's not Microsoft you'd go to, which is one of the least volatile companies. You'd go to cash. Okay, that's how you remove it. So there's an extent of market risk you can't remove, no matter how many stocks you own. You'll be still subject to market risk unless you remove yourself from the market. So company specific, well, you could have 20. What we found when we were doing an analysis last year, and we hold things for 12 months, so we looked at which stocks in January met my approved filtered list and would be held for 12 months, and then in February for the 12 months then, and so on. And what we found is that actually you didn't get a better performance by having, say, 15 from that approved filtered list, and assume all the ones in the approved filtered list are all equally good, compared to having, say, 50. So I'd say a number between 15 and 40 is ample, because like I said, the diversification benefits are not as great as you think. So it really then comes down to, well, why else would I want more than 15, or not want more than 15 if it's not performance that I'm going to get by having more or less? The reason is you don't want to then get paralyzed by owning so many. It's easy to buy, but when you look at it on your spreadsheets or on your brokerage, you think, oh, what should I do? What should I do? And then I've got loads of clients who'll just come to me and they'll show me their portfolios. And it's like, where the hell did you pick these from? You own half the FTSE. What are you doing? Oh no, I was just uncomfortable. So I bought that and bought a bit of this and bought a bit of this. And of course, then they don't change some of the stocks. Even if they had a good year, they go, yeah, 10 years ago, I had a really good year with that stock, because they've got so much they can't move. So I'd probably say stick to about 20, so it's manageable, and you're not going to get investment risk. You might say, well, what if all 20 are in the same sector? Well, of course, within the same sector, you're going to be a bit more correlated than outside of it, but you're not going to be as correlated as you might think relative to outside of it. And it's the data that I'm relying on for that, not intuition, which says, oh, surely retailers and software companies are completely uncorrelated. No, when the markets fall, the correlation numbers spike up.
Right. Last couple of minutes, Alpesh. I know this is a stock picking event, but do you have anything that you can share about the other markets, the currencies markets, and maybe the crypto markets? What's going on with the end? Interesting.
Well, crypto, I've said, is always like, it's a bit like modern art. There is something on crypto I can share. Let me just see if I can pull that up.
I read a very good article that you published a few weeks ago on NFTs. I think that's on.
Yeah, I'd written one about, on NFTs. If you look at my LinkedIn, and the links are sort of in my bio, I'll put the links up there. That was interesting. Now, I don't, the cryptos that I have, I've sort of put locked away and forget about it. I'm down 90% on Ripple, so that should tell you I'm not the person to ask about crypto, shouldn't it? But then again, who knows, in the next 7 years, because it was bought forever, Ethereum, surprisingly, is up. I then did another experiment where I just bought a whole load, little sums of money, because I'm not an idiot, contrary to what you might think. I bought a whole load, which was just based on their momentum. Okay, and some of them did well, some of them didn't, and overall it was a waste of time because the good ones, so that didn't work as an experiment. I just did it for fun. So what would I say? Look, I'd say it's like modern art. Oops, sorry, that link is wrong. It's like modern art. But you look now, and I looked at some of the artists who are doing well so many years later in modern art, and some of them, Damien Hirst, you can buy his stuff for peanuts. Others, Jackson Pollock, still kept value. So, just just don't get bought into it, I guess. If you're going to buy it, you buy it with risk capital and assume you've lost it. It's like going to Vegas. Just do it for fun. That's all. That's the best I can say about it. Now you might argue, oh, but Alpesh, it's so useful. Yes, the languages are different to the currencies. So at Ripple, I met the team of Ripple, and if you look at who's invested in that company, which produces the language, Ripple, the investors are like Google Ventures, they're like Sequoia, Anderson Horowitz. They are the best of the best. Okay. The language is useful. The Bank of England, I met the governor of the Bank of England. He was out in India, and the Bank of England is trialing how to use that language to transmit capital. So you might think, oh, I'll buy XRP. And the Ripple guy said to me, I wish people had realized Ripple, the company, and XRP are different things, in the sense that XRP is the coin and it's not correlated to the usefulness or anything else, sadly. You might say, well, surely one day it will be. I wish it was correlated to the utility of the language, just like GDP of the United Kingdom is not really correlated to the number of English speakers around the world. The language is different to the coin and the value of the pound, I'm afraid. Well, no, there's got to be some correlation. More people are likely to trade with us. Yeah, there is a loose correlation. Other factors overweigh it. So it's the same with Ethereum. Useful language doesn't mean that the currency is going to do well.
Yeah, nothing like NFTs and cryptocurrencies to make us feel instantly old overnight when I hear people talking about the coding. One final question, Alpesh, from Mabs, just before we let you go. How does stock picking compare with ETF or mutual funds or even Forex?
Yeah, so the people you'll get doing ETFs, and let's assume you're just talking non-leveraged ETFs and plain vanilla index trackers like the S&P 500. So somebody like Warren Buffett would rightly say, look, if you're a total beginner, you've got less risk on an index tracker held for the long term, because you always reduce risk by holding for the long term in an index tracker sizable like the S&P 500 or the FTSE 100. Then if you try and pick a basket of 15 stocks, generally you will tend to do better if you're a beginner. If you're trying to, and mutual funds tend to be a more expensive version of ETF, so I prefer ETFs over mutual funds. Forex tends to be harder, but you're doing it to try and get more gains. What you're doing with Forex is trading, obviously. I'm just trying to sort of show, oh, I think I'm going to try and, yeah, that's not there. What you're doing with Forex, I deleted them earlier, is you're trying to make more money, but it's harder. So that's where, you know, when you see on the brokers, 70% of people lose money with this broker. Yeah, 30% make, 70% lose, and you're trying to make more money than you would with an index tracker or even with stocks. So it's a trade-off between risk, probability of making money, and likely returns. So you get a lot of people saying, yeah, I understand with Forex, so I learn it, I might make more, but the probability is low and it's going to take up a lot of my time, so I don't want to do it, which is fair enough. And others will say, I'm really risk averse, I'll just have an index tracker. And I'll say, well, I have an index tracker and I'll pick a few individual stocks because I want more than what the index tracker will give me. Like I'll pick an Amazon or a Microsoft because I've ticked the boxes on valuation, revenue growth, and so on. So they all have their place. But for most people, the safest thing I could ever say to you is probably repeat the words of Warren Buffett. If you don't want to pick stocks and this is not for you, then probably an index tracker is the safest thing, all other things being equal, for the long term. Not, you know, if you're going to retire within 2 years, somebody said on CNBC yesterday, and rightly said, you probably shouldn't have any equities if you're going to retire in 2 years, because you might lose 50% of your pension pot. Okay, that's a safe, sensible thing to say.
Final question from Emma. For your analysis, do you ever use 4-hourly or daily charts, or
so
more?
If I'm trading, if it's trading, then the 30-minute charts and the 1 hour are the best, or 15-minute even are ideal, and that means holding a position usually between 1 to 2 days to about a week. For investments, I'm looking at 12 months, and I don't normally look at the technicals except this year where it's so clear they're falling. For the last 10 years, pointless for a 12-month holding to look at technicals and try and time an entry, just because everything kept going bloody up. So, you know, it was only going to go up after a couple of days, so why waste my time? So there I would look at, as I showed you earlier, the spreadsheet which just went through, I mean, that's ETFs, but I would just go through the filtered versions of this. I'd just be looking at all greens, as much greens as possible. in those, and based on the factors. And most of this data, right, the reason for analysis is just based on the academic research of others, 3 Nobel Prize winners in particular, who I've been following for the last 20 odd years and been writing about in my FT columns and in my books. And so just taking all of their stuff and putting it into a way of finding out what's going to do well. And it doesn't always go up, because guess what? Even after all of that, to give a simple, obvious example, Microsoft still fell. You know, I can't elevate the market through use of the Force or Jedi mind tricks, sadly.
Oh yeah, the Obi-Wan Kenobi is being viewed in this house at the moment. So, absolutely. Alpesh, thank you so much for that. I'm going to let you go. We could spend another hour or two, but in fact, if people do spend more time, come and join us for the 2-day summer school. We're in the end of July, so there we are. I'll be with Alpesh. And
my son's the best stock picker there is. He's massive on TikTok. He's 4 years old.
In these TikToks.
Right. He's going to be there with us.
Alpesh, thanks very much for joining us. We're going to go over to Paul Roberts now. Thanks again. Take care.
See ya.
There we go. Thanks to Alpesh. We've got another, another 30 people have joined us actually just in the last sort of half an hour. So welcome to everybody that's here, and thank you for joining this event today. We are live for 3 hours. As we can see, we've just been listening to Alpesh Patel, who's the host of the UK share picking game. My name is Simon Campbell from IX Media, and I'm working with Paul Roberts at Stockomendation. It's a big collaborative event. There's lots of good people involved to bring this to you, to bring the share picking game, the Stockomendation service, and these fantastic live events. We've brought Paul in, just going to spend 10-15 minutes to tell us a little bit more about why you should copy successful investors. This is the premise of the Stockomendation service, and if anybody's not been on that yet, I'll post a link in the chat box so you can go and take a look. Loads of people in the share picking game are using Stockomendation so that they can find these high trending stocks that Alpesh was talking about. Paul, hello, you're there.
Can you hear me?
I can hear you, yes.
Fantastic, the technology works. Thank you, Alpesh, as ever, fantastic.
Always fantastic. I'm going to make you the presenter now, so we can see your screen.
You come on, sorry. You hand it over. There you go.
Make you the presenter, yeah.
Great. Okay. Well, hello everybody. Thank you so much for coming. Thank you for joining us. Thank you to Simon at IX Media, our educational partner with Stockomendation and the UK share picking game. And as Simon was saying, it's a great collaboration between us, IX Media, Alpesh, Trader Minds, Round the Clock Trader, Campaign for $1 Million, Stockomendation on the UK share picking game. Our passion is very much about bringing the institutional type advantage to us everyday lay people who constantly get sideswiped in the market by the people that have sort of hold sway and control it in many ways. And one of the reasons I started Stockomendation, which started out of an Excel spreadsheet originally, was I got stuffed by a share pick from a well-known UK broker. And I put 20 grand into this many years ago. And then they got me to another research note came out, and I put a little bit more in, it was going up. And then about 3 weeks after the next load of money went in, the company went into administration. So that was advice from a major UK broker. I call them Stupid Dolphin, and you could probably understand from that what their name is, because the last name is a mammal. So if you find out what their real name is, stick it in the chat. It's not a penguin. It's something else that swims around in the sea. And that's the major UK broker. They lost me 40 grand. And actually, that's how Stockomendation was formed. Just out of utter frustration of going, hang on a sec. I asked this company, what is the performance of the analyst that gave this share pick to the broker that advised me to buy this stock? and they refused to give it to me because I was a retail investor. And so I just got so angry, many years later, Stockomendation was formed. I built it out of an Excel spreadsheet, and then we went and raised a lot of money, and then we built a team, and then we just gone from one to another. And now we have 16,000 people using Stockomendation to actually see what the performance is of analysts and tipsters in real time, because it's really important. The past isn't necessarily a future of, give you a guarantee of the future, but it gives you an indicator. If someone's an idiot, they're an idiot in the way that they go about their business. And you go out with them at night and you can guarantee off a few pints, they'll still be an idiot, and they'll carry on their behavior in that sort of way. If a share picker is really bad, and especially bad in a particular sector, they'll continue to be bad in a particular sector unless they have some magic sort of, monkey dart throwing process end up, hitting. But the reality is, it's really important. Hit rates in the market are really important. If you say something and it goes in the right direction of travel, it's important, it's a hit. If it doesn't go in the right direction of travel, it's a miss. Now, they are not the key indicators for share picking. They are an indicator for share picking. What's really important is within that process of hits and misses is how one creates a trading strategy. So do you have a stop loss? Do you get in, do you get out? Do you look across the market at how many other people are, involved with the positive recommendation or sentiment in relation to the stock, et cetera, et cetera. And this is where you can learn through people like the speakers coming, like through Alpesh and through Jamil, through Stephen, and through David Paul, in relation to getting a broad consensus of information from across the board, not just in one place, not just in two places. You need to go to several places, but you need to have it, in my opinion, in an uncomplicated format. So Stockomendation, because I'm probably the stupidest person on this entire seminar, in fact, when it comes to mathematical ability and trading ability. So I need to have things simple. So we've created a simple model, which is following success. So there's no people throughout history. I mean, Aristotle would probably just say, and probably did say at some stage many thousands of years ago, don't reinvent the wheel, just replicate success. So what I like to do now is I'm going to show you, take you through a small deck, chat through a little bit of what we're up to, and see how you can benefit overall. Can everybody see my deck okay?
We can't see your deck, actually. I'm just looking. Oh, now we can. Great.
Yeah. All right.
Yeah. I think
there we go.
Does everybody else now see the? We should be looking at the Stockomendation slide. It's not in full presentation mode. We're looking at the.
Right. Apologies. 2 seconds from beginning. Here we go. You're looking at my PPT. How are we doing? We're in business, yeah?
No. Okay. So now we're in the preview. Got to display settings at the top. Yeah. Just pull that down. Just swap. Just press that. Swap.
Oop.
Just say swap. Swap presenter view and slideshow, and then we should be in business.
Yeah. There we go. Are we good?
We are now. Yeah. It's just a second too loud. Okay. So
great.
Paul, great. We're looking at the first slide.
Fine. Thank you for that. Sorry for the little technical glitch there. Okay, cool. So what is the problem? We are all bombarded with too much information. If some of you may have seen some of these slides before, and I'm going to reiterate them because they're really important. We are bombarded with too much information. Most in platforms add more confusion, not take confusion away. I, like everybody else, I am time poor because I'm very busy. I'm knowledge poor because I'm not an investing expert. That's not what I do 100% of my time. Technology and helping using data intelligently is what we are about. But I'm knowledge poor in the sense of, I can't read a Tesco's balance sheet effectively like the majority of us in the UK. We've all been burnt in the past. You heard my story being burnt by a very well-known broker, Stupid Penguin. And also, we need an affirmation for trade. If you look at brokers, 80% of most broker accounts don't really trade, hardly at all, because either someone's been burned, or they don't know what to trade, or they can't be bothered, or they just find the whole thing overbearing. So it's a shame, because what that means is it's keeping people out of wealth when they need to have access to a share of the wealth part of the world. So, you know, here's our little men now, little Stone Age men. You know, very obviously there's a nice round wheel, but, you know, carry on doing what we're doing. Too busy, no thanks, just carry on slogging away with the square wheel. So the small investors paradigm is, who should I trust, who should I listen to, who should I invest in, how can I improve my investment returns, and how can I make money and preserve my wealth? And preservation of wealth has been the key thing in the last several months, of course, as markets have been, you know, chaotic. And the FTSE is returning close to zero, but there's some phenomenal stock picking opportunities in the market. And, you know, this is where the UK share picking game has been really great to highlight some fantastic momentum opportunities and also some solid share picking opportunities from some of the top stock pickers. So, you know, as share pickers as well, we can only buy a small fraction of a large stock pool of a stock picker, not like a big fund can. So we've got to be very selective about how we allocate our resources. So don't reinvent the wheel. You don't have to. You know, you really don't have to. What you need to do is you need to replicate success. And you know, looking at what Alpesh does and the way that he is very open with his portfolios, with his investment strategies, and with his approach to market, you know, that's successful. So, you know, replicate success. Don't go it alone. And if you want to go it alone, it's fine, but use that risk money like Alpesh is talking about with crypto. It's just risk money. If you lose it, you lose it. If it hits, it hits. But that's not investing. That's speculating. Investing is a different model altogether. And trading is different too, because it's obviously a shorter term window. Tony Robbins, great philanthropist, the world's greatest trainer, brilliant businessman, huge intellect, and a great story of humanity. If you want to be successful, find someone who's achieved the results you want and copy what they do. You will achieve the same or equal results. So copying is really important. Find good people, see what they do, and do what they do. You may not get 100%, but even if you get 80% of the top people, that'd be fantastic. I mean, how many portfolios do you see which are, you know, indexes do you see which are, you know, Warren Buffett clone type sort of environments? So we're a FinTech 50 award-winning platform. We have two platforms. One is the Stockomendation.com, which is the UK's only and largest aggregation service for share picks, broker recommendations, tipster picks, and newsletters, newspapers, magazines, journals, wherever we can find someone saying buy, sell, and hold that are FCA regulated pieces of content. We will track them, put them in our platform, and over time you'll get a really great track record of understanding who is good and who is to be avoided. So, you know, it's really important that you know who is good and you know who is not so good. It's your money that you're betting on the markets here. And there's a lot of people out there who are just very, very, very poor share pickers. But when you look at their social, when you look at their websites and this, that, and the other, you'd think these guys are, you know, the hottest ticket in town. You know, someone doesn't want to show their true performance. If somebody doesn't want to be tracked in real time and over extended period of time, then, you know, that says a lot about the individual. So we combine technology, market analysts, stock pickers, and wisdoms of the crowd. Wisdoms of the crowd is now to the game. So there's some of the phenomenal stock pickers we're seeing in the game. Well, absolutely putting hedge fund managers and the average fund manager to shame. No disrespect there to hedge fund managers, particularly close one there, Mr. Patel. But you know, the performances are outrageous, and these guys are really good. They're very good at what they do. So we like to discover the highest achieving and most consistent professional and amateur stock pickers to help us, you know, poor knowledge overloaded investors to get the highest chance of success. And we employ a highly sophisticated technology platform that we've created over many years in order to do that. So it's an academically certified platform. So next up, hang on a second. There we go. Where have we gone? Can you all see me okay? My system has just decided to not play ball. Am I still in the game there? Simon, can you still hear me okay? There we go. Can you just stick in the chat box there, Simon, if you can still see me? I'm getting a bit of pushback from my Wi-Fi, I think. Can you see me okay, Simon?
Yes, we can see you okay.
Yeah, okay, fine. Sorry, I lost you for a second then. Right, so let's look at improving the wheel. So we harvest the latest stock tips, recommendations and sentiment from UK market. We track the performance of a stock picker over time. This creates a comprehensive track record and history and covers a pattern of success or failure, and then our algorithms work out who the best to follow and who are the best to avoid. And what can be more simple than that? So consistency is the goal of investing. Knowing who to trust in today's markets is the key to strong investment performance. So with a big partnership we did with Innovate UK, which is the UK's government innovation agency, with a leading UK banking finance department, we created what is known as the Stocko score system, the trading signals platform, and a unique academically certified system that helps us find the stock picks and the stock pickers who are most likely to outperform the markets consistently. So this is kind of all you need to do, really, in many ways. You need to follow the best 5-star gold standard Stocko score rated stock pickers. The 3.5 to 5 stars, they generally perform in many ways. They perform very, very well. There are some shocking examples within that of people being hugely inconsistent. So the average fund manager's performance through The Art of Execution by Lee Freeman Shaw's investigation into fund managers in the UK is about 51% hit rate, which is scary. In the game, I think we're up to nearly 80% in terms of hit rate, and the top stock pickers in the trading signal platform is somewhere in the region of 90%. So if you're walking into a casino with your hard-earned cash, which income tax has been slashed and burned that hard-earned cash to smaller cash, you'll probably get about the same round of blackjack table as you will as giving your money over to a fund manager in the UK. That's just fact. So really what you want to do is if you walk into a casino with your hard-earned money, knowing that you've got a 70 to 80% chance of making money on that hard-earned cash, you have a higher confidence level and a much better chance of earning some real money. So Stocko Scores is a visual rating system, okay? So it takes you on a journey from 0 to hero. 0 to stay away. I mean, they're just useless. They do not hit well, they have bad consistency, they do not make good stock picks, and they have no skill in a particular sector, and just ignore them. You want to be looking at 3.5 to 5 stars Stocko score rated stock pickers. So some really amazing content, there's some really amazing performances, and there is some really amazing consistency within the brokers, the analysts, the UK share pickers, within the 3.5 to 5 star stock pickers. Now, more than anything else, most people will moan to me saying, well, I don't know what to buy. This is why 80% of brokers' accounts don't have much activity, because most people don't really know what to buy. Time poor, knowledge poor, got afraid because they've already lost money, like I did in the past and other people, and once bitten, twice shy. So there has to be an affirmation, there has to be a reason to trade, there has to be a reason to trade. And the only reason to trade is either you've got a stock that you need to trade, whether you want to buy more of it or sell it, or you want to find something else to acquire. So if you want to find something else to acquire, what are you going to do? Read a newspaper, read a magazine, read an article, sign up to a million different platforms in the market, come onto these seminars. There's loads of different things you can do. But that's, again, we're time poor, right? So what we've done with Stockomendation is the idea is to say, well, look, we can show you who is a 5-star rated analyst, 4-star and all the way down to 0. So you'd be more likely to look at a 5-star rated journalist or analyst or stock picker or tipster, and then you would go and do some research on the basis of that. So Stockomendation not only helps you understand what to pick, sort of where to sort of look, but also what to pick. Okay.
Well, we'll need to wrap it up. I'm afraid we've run out of time. Can we?
2 seconds. I can't believe I've gone over time already. And there's me saying,
yeah, that's all right. No, I think we just took a bit longer in the first session than we anticipated. So sorry for this.
But Alpesh again.
Always.
It's okay, Alpesh, you can steal my time. So just very briefly, I will wrap it up. So trading signals is really important. So trading signals is a product which is who makes the best share picks, the best signals, which market segments are they best in, and what type of signal are they best at, buy or sell. This is what we have in the game as well. You find out who is a good buy stock picker, who is a good sell picker. On Stockomendation, you can see who's a good buy picker, a good sell picker, and what sectors they're really good at. So you know, when you use Stockomendation, which all share picking game players, UK share picking game players, have a free account, that's where you want to be. That's the areas that you want to be looking at. And then sign up, you know, with your watch list. Build a watch list of individuals you're interested in, publications you're interested in, either the newspapers or the tip sheets or banks or brokers. And then you'll get instant free email alerts from the free side of the service, or you can upgrade to different types of products and services within the platform. So you can see immediately in real time if a stock that either you're invested in or you're interested in has got a load of picks about it. But don't forget, this is important on the downside as well as the upside, because if the market moves against a share that you're invested in your portfolio, and all of a sudden 3 or 4 sell picks come out about this over the next 2 days, you won't know about most of those. We'll capture most of those, and we will alert you of that, and then it gives you an opportunity to therefore make your trading decision, whether it's protecting your wealth or whether it's sort of buying something else. Okay, so I think I can sort of kind of kill it there really, if you want, Simon. But just to give you an idea, the average performance in May of our trading.
Yeah, I think the best thing to do is to jump over to the links in the chat box there to the Stockomendation website, and everything will be there. But clearly we're here as well. Any questions for anybody that wants to learn more about that, just contact myself. I can put you in touch with Paul directly, or one of the team. But yeah, no, I'm sorry to say I'm just
it's fine, it's great, and you know, I'm looking forward to listening to everybody else. And you know, just to let you know, in the trading signals in May, you know, we're 4.61% average performance against a 0.36 average performance in the FTSE All Share. That is a 12 times more profit from buying 2 shares than by being stuck in an index tracker or being stuck in a fund or making your own share pick. So that's the kind of information that you're going to find in our systems, and we'll help you around that process. So thank you all for listening.
Fantastic. Thanks, Paul. I'll take the presenter role back, and we're going to go across to David Paul at VectorVest now. So thank you very much, Paul Roberts, founder of Stockomendation, and of course the UK share picking game. Many thanks. Speak to you soon. Great. Okay, I think I'm going to unmute David. He's managed to do that himself already. David Paul, good afternoon.
Yes, good afternoon, Simon. Hello, Paul. Hope you're all well.
David, I'm sorry to keep you waiting there. I know we're about 5 minutes into your time already, and
no worries, man. No worries.
Apologies for that. Just to say hello to people that are checking in the last 20 minutes. You're here. This is the Picking Stocks in Volatile Markets Summit. My name's Simon. I'm hosting the event today. We've got some great speakers. It is being recorded, so if you're just joining us, you can catch the replay afterwards and go back and miss anything that you haven't seen so far. How to pick stocks to beat inflation. David, that's something that everybody's interested in this year especially. And I know that VectorVest has got some particular tools that can help keep investors to find these little market gems. Shall I make you the presenter now? We'll check that we can see your screen. Of course, anybody that doesn't know, David Paul is the Managing Director of VectorVest in the UK. VectorVest has been around for 40 years, David, is it? Or
I think it's 32, Simon.
32, not quite 40 yet, but a long time. Great track record, of course, in the US, but not only in the US, it's in various Australia and Europe, and of course the UK as well. So all the parts of the globe are covered. All the stock markets are there. David, we can see your slide now, which is great. I'll hand over to you so we don't eat up any more of your time. Over to you.
Okay, all right. Well, good afternoon, everyone. It's a great honor to be here, Simon and Paul. Thanks very much for having me. I'm David Paul. I'm the Managing Director of VectorVest here in the UK, and I've been using VectorVest as a tool for the last, I suppose, 12 years now. Well, the first thing I've got to do is put up this. VectorVest, I think, is the only company in the United Kingdom that sells investment advice and sells investment software that's authorized by the regulator, the FCA. And although I'm qualified to give financial advice, I can't do so because I haven't sat down with you and done a long and a detailed fact find. So I'm allowed to talk about shares that I hold myself, and I will do that this afternoon. But I have to make it very clear that although those shares are suitable for me, they may not be suitable for you. So that said, folks, we're not talking about day trading here. I know there were some questions, Alpesh, about day trading. I do quite a bit of day trading myself for a bit of cash, but we're talking about end of day trading here and end of day investments. And our objective in VectorVest is to give you the tools that can do all the heavy lifting for you and give you answers so that you can actually make some money in the market in 10 minutes a night. Okay, so we're not sitting in front of this thing. The tail is not wagging the dog. So that's your humble correspondent. Unfortunately, the photograph taken a couple of years ago. That was my last trip to the New York Stock Exchange. That was December before the portcullis on flying fell just before the COVID thing. So I think I've aged a bit in the interim, but come this October, it'll be 40 years since I put on my first trade in the stock market. And that was a trade in South African breweries. I was living in Johannesburg at the time, and it was a winning trade. I traded while I was working for De Beers, the diamond people, until 1988. And in April 1988, I cut the corporate umbilical cord for good, and I've been trading on my own ever since. As I say, 12 years ago, I discovered VectorVest, and I promoted VectorVest in South Africa, and then started to promote VectorVest in the UK. And I've been back in the UK here now full-time for the last 5 years. I went to South Africa in 1981 to play professional rugby. So that's me. So what I'm going to talk about is the VectorVest system of analyzing stocks and shares, and I tend to use the word interchangeably. I think what Alpesh referred to earlier, market timing, we believe at VectorVest there's a safe time that it's easy to make money in stocks, and there's a time where it's darn difficult to make money in stocks. And you need to be able to work out easily when it's safe and when it's not safe. And then I'm going to look at how to find and how to easily find strongly growing stocks for your portfolio for trading. And I'm going to look at two portfolios, a fairly conservative portfolio and a more aggressive portfolio. And I'll show you how to find those stocks automatically. I hope I don't run out of time. So the cornerstone of VectorVest, folks, is valuations, and we want to buy into stocks that are trading less than their value. That may sound obvious, and every day VectorVest puts a value to every share on the London stock market, to the American stock market, the Canadian stock market, the whole of Europe, and Australia. That's the VectorVest world, which comes with the standard product of VectorVest. And we believe, folks, the following, and I have a PhD in mathematics, so I'm not content unless I've got a pen in my hand. Every investor should know the following. What's a stock really worth? How safe is the earning stream? And conservative investors will want to be quite focused on this. More aggressive investors can drop the safety requirements. And then some idea, is the darn thing going up? Is the darn thing going nowhere, or is it falling? Now you'll find, especially those people that are new to this, that haven't experienced this, that they're great fun when they're rising and not so much fun when they're falling. So we assign a buy, a hold, and a sell to every share in the market every single day. And I assure you that all those high-profile stocks like Zoom, etc., and Peloton, those have been on a VectorVest sell recommendation in the US since last November. And VectorVest would have kept you out of all of those disaster areas. As I say, they're no fun when they're falling. These two, folks, would largely be known as fundamental measures of the company. And this is a technical measure of the share price. And everything that occurs at VectorVest is all about putting together the best of those two approaches, the best of fundamental analysis with the best of technical analysis. So in essence, we're looking for a stock that's growing earnings strongly, reasonably safely, that's rising in price. So we are trend followers in stocks with outstanding growth fundamentals. That is the approach. That is the vanilla approach. It's the approach that I, in fact, teach all VectorVest subscribers, certainly all the new people, until they get their own trading plan in place. And we do coaching after coaching after coaching online these days to make sure that everybody, after using VectorVest for a week or two, has got their own trading plan in place. So let's look at value in a bit more detail. Every day, we put an indicator of the long-term share price appreciation potential. And for long-term, we read 3 years in relation to what a corporate bond will pay over that same period. And that's why it's called relative value. It measures the share price upside in relation to what the risk-free rate will give you over the next 3 years into the future. Now, that's a function, folks, of the share price now and earnings growth. So if the share price is too high now, it doesn't matter how high the earnings grow, the relative value may not be good. Now, on a scale between 0 and 2, a relative value is less than 1 is not good, because that's saying that this share has got the potential to grow less than what a risk-free rate will give you. Greater than 1 is not bad, and greater than 1.25, ladies and gentlemen, really pushes the share price over that 3-year window. Now, there's no timing in this, and many of you will say that 3 years is a long time, but it's a strong fundamental wind at the back of a stock. Now, in all of my investing, I don't like to look at stocks with a relative value of less than 1.25. So that's our first VectorVest metric. The second is relative safety, which measures the safety and the predictability of the earnings stream. Now, in relative value, we project the future, and as Mark Twain said, the future is a very slippery commodity. In relative safety, we're looking at the past. So we're looking at the balance sheet, the income statement, the cash flow statement, sales growth, margins growth, margins shrinking. And out of that, we spit out one number which represents, as the slide says, the consistency and the predictability of the financial performance. Now, on a scale between 0 and 2, less than 1 is not good. This is a set of numbers that have been up and down, in and out. Now, for aggressive investors, that may be okay. But for conservative investors, I've shown a million times that when the relative safety gets down less than 1, that the probability of a surprise goes up. For example, a small mining company may have a relative safety of 0.65. It's got one shaft, it operates in some godforsaken place, and if some idiot drops a wheelbarrow down the shaft, the whole thing is stopped. If the compressor stuffs up, they have to send a truck 250 kilometers to get a spare. So lots of risk in small mining operations. Greater than 1 is not bad, and that's a good place to be. And greater than 1.25, 1.3, that's a very conservative place to be. Since COVID, we've only had one company with an RS of greater than 1.3 that's let us down. And that was Avon Rubber, now called Avon Protection. They bought a company from 3M that manufactured body armor, and the body armor didn't work. Simon, as I think I've told you before, it could have been worse. They could have tested the body armor on you, sir. But the body armor didn't work and the share price fell. So a high relative safety does not get rid of risk, but it minimizes risk. And if you want a worry-free type portfolio where the ball simply does the work on its own, then you would want to stipulate a high relative safety. And in my conservative portfolio, a little bit later on, assuming I don't run out of time, I'll get there. So we're looking for an undervalued stock, a stock that's growing earnings strongly. That means a high RV, reasonably safely, at least as safely as you require to allow you to sleep at night. That's rising in price. And relative timing measures the short-term trend. On a scale between 0 and 2, like everything else, less than 1 means the darn thing is falling. No fun. No fun at all. Greater than 1 means it's rising, and the further above 1, the faster it's rising. And in my aggressive portfolio this afternoon, if I get there, I've asked for an RT of greater than 1.25, which means that this share is within the throes of a strong term trend. So undervalued, growing earnings strongly and safely, that's rising in price. And VectorVest is built to give you answers, to allow you to actually make decisions, to manage your risk in a few minutes a day. So you don't need 100 PhDs running around or 100 CFAs running around. I had an asset management company years ago in Cape Town, and I had to employ a CFA, they told me, and the sod couldn't have treated as well in a wet paper bag. We put these together and rank all of the stocks on the LSE by a combination of value, safety, and trend. And like I said a second ago, this single number puts together fundamental and technical analysis. And I'd never seen that before. We want to put the best of both worlds. And in fact, that's my dear friend Zach Meir. When I first presented VectorVest to him a lifetime ago, he said that VectorVest is the best of both worlds. I'll never forget that. We calculate a stop loss for every share in the market every single day. And if I had more time, I would go into the detail of that. And we put a buy, sell, or hold to every share in the market every single day. And as I say, when they're rising, hopefully they're on a buy. Frequently, they're going to slug it sideways, folks. They don't go up in straight lines. They go up in a series of steps. So that would probably be buy. That would probably be hold. You've got to sweat it out. And then all of a sudden, as an investor of yesteryear, a gentleman called Richard Wyckoff used to say, the market fell through the ice. And that's what happened to Zoom. That's what happened to Peloton. And Lord knows how many other favorites of the work from home era. VectorVest had those on sale recommendations from the end of November last year. And Facebook's another one, or Meta, whatever it's called. Now, I've taken some snips of the top VST stocks. And this is a stock, and I have to let everybody know that I am a shareholder in this stock, and it's been great. This was done last night after the close, I hope. Trading at 13.50, VectorVest believes it's worth 17.83. So that's our first tick Alpesh talked about ticking the boxes. It's undervalued. Now, I know this stock well, folks. This is the old Amcoal, which was Anglo-American, listed in London, coal resources in South Africa. And it was listed after that COP, whatever it was, up in your neck of the woods, Simon, Glasgow last year, because coal was the Antichrist, right out of the book of Revelation last September, October. And of course, with the energy surge that we've seen, everybody now wants it. So it was up 5% yesterday, looking good. Although the share's been running for 6 months plus, the RV is 1.91, and that on a scale between 0 and 2 is rare to get it up that far. The RS is 1.37. This is a superbly managed company. It's been running as a unlisted entity within Anglo for 70 or 80 years. Contracts in place, multiple mines, multiple shafts, exceptionally good management. So this is not one little mine with one little shaft in the middle of nowhere. And the RT is 1.81, and when we put RV, RS together, that's at the top of the pack. It's on a buy recommendation, has been for a long time. There's the VectorVest stop loss at 1164. Now, I didn't get time to talk about this one. This is the long-term trend. It's called the CI, the Comfort Index. And the short-term trend is the RT. So on this share, both the short-term trend and the long-term trend are moving up strongly. GRT is our best shot at the percentage annualized growth of the stock next year, and that GRT number at 51, that's quite special, isn't it? And this company, of course, is cheap on a conventional PE, and my sources tell me that they've got 60% of the share price sitting in the bank in US dollars. So that looks, there's the chart, folks. There is the entry point from your humble correspondent, as Ernest Hemingway used to call himself. Those of you that are technicians should be able to see the cup and handle pattern made famous by Bill O'Neill. The green line above the price is the VectorVest valuation. The blue line study down here is forecast earnings per share. Doesn't look as if it's moved up much here because of the step, but since April, that's a 50% increase in earnings per share. The stock is going sideways and looks to me, nobody knows what's going to happen next. Only an idiot would predict what's going to happen next for sure. But the probabilities to me look as if that's about to break. Had a good day yesterday, and as you can see, the volume is ticking up, which is a good sign. Folks, you do not, there's the buy signal on VectorVest. I got in a bit later, just there. And it's been on a hold for a couple of days. Hold means hold, and it was on sell there for a while. So it turned and moved to sell. That was this, and I would be surprised if that doesn't get much higher. But maybe I'm talking my book because I'm a shareholder and I've added to it a couple of times. This is the second stock, Gulf Keystone Petroleum. Now, energy is hot. Energy is hot, and pretty much the only thing worldwide, energy, shipping, fertilizer is pretty much the only thing moving worldwide. Now, this is the second one, but it's undervalued. There's our first tick. RV is incredibly good, but the RS, ladies and gentlemen, if you see this performance of the stock over the last 10 or 15 years, you will understand why the RS is on the low side. There's been some ups and downs, I assure you, a lot of debt, although that's being quickly paid off. RT is through the roof, 1.71. The VST is really good. So all the numbers are good, except that conservative investors would worry that the RS was on the low side. So perfectly good for more aggressive people who are watching the stock every evening, putting stop losses into place. There's the stop loss. And the CI couldn't be better. It's going to grow earnings at 38%. So immediately, folks, we've analyzed that stock. It's undervalued. growing earnings strongly, reasonably safely, and both the short-term trend and the long-term trend are up. 30 seconds to analyze any stock. There's the chart. That was the last end buy signal just there. Okay, undervalued, growing earnings strongly, and trending up in price. One more, Cape Tech. Now, Cape Tech is I am a shareholder in Cape Tech, so it's undervalued. RV is great, RS is fair to good, RT not great. VST is good. It should grow earnings at 44%, but technically it's slowed down here. Both the long-term trend and the short-term trend are not looking great. If you look at the chart, I put this chart up over the last 3 or 4 years now, 2.5 years. It's undervalued, growing earnings strongly. Certainly there was a great up bar here. I don't think that you need some very simple technical analysis with VectorVest, and it has in fact come right back to the support level, and that's always a good place to get in. It's on a hold, so my advice to everyone is to wait for that to print a buy signal before getting in. If you got in there at around there, then you're sitting and you're sweating it out. Okay, looks fine to me, and I in fact myself bought in there, and I am sweating it out. Now, every Monday afternoon, folks, I run a 1.5 hour webcast where I show everything that I do, all the trades, warts and all the good ones, all the bad ones. My entries are quite aggressive. I'm a trend follower in shares with great fundamentals, and I want to buy them at support. Many people will buy the breakout, and that's great. Some of the richest people in the world buy breakouts. David Harding from Winton has made £1 billion buying breakouts. But my own strategy is to find a trend in shares with impeccable fundamentals, and then buy the little buggers as close to support as I can get. And the best entry is the first VectorVest buy signal. So that's what I do. Now, as Alpesh mentioned, there were years where it was easy to make money in the market, and there were years when this year is really, really difficult. Our mantra is buying rising stocks in rising markets. And the founder of VectorVest, Bart DeLita, puts it so well when he says being on the wrong side of the market is the worst thing that can happen to an investor. It doesn't have to happen to you. So it's easy to ignore, and that's my metaphor, ladies and gentlemen. It takes forever to get up there, and the darn things fall very quickly. So on VectorVest, we've put market timing on the front page. I firmly believe that 70% of the exercise is working out whether the market is rising or falling. Everything follows from that. And I've blown up the bit, which is in fact all about market timing. And unfortunately, it doesn't look great at the moment. There's only one measure of the trend on VectorVest UK up. And as we go into the market today, we've got a down situation. That means the short-term trend of the London market is down, and the underlying trend or the longer-term trend is down, and the longest-term measure of the trend on VectorVest is also down. Now, and the advice is very simple: sit on your hands. For a few days, the short-term trend had turned up, but that seems to have keeled over yesterday. So sit on your hands, wait for at least the short-term trend to turn up, and this little fellow to move in here somewhere. Now, that's the long-term signals, and that's since COVID. There's the COVID sell-off, and that was a really good exit about there. A lot of these, there was the first buy signal. And ladies and gentlemen, especially those people that are new, if you only get one thing out of this afternoon, just write down the following. When it's time to buy, you won't want to, I assure you. the good trade is always the hard trade. I'm not saying it's hard intellectually, I'm just saying it's hard emotionally. Down around there, that was the first week after we locked down in the UK, just there. That was the first week we locked down. All of a sudden, I was telling people to buy shares. VectorVest was telling people to buy shares, and I was laughed at. In fact, I was laughed at by emails with some fairly colorful language. There was a sell signal, but it came to nothing. So when you get one of these red signals, it doesn't mean sell everything. It means don't buy any more. Watch your stop losses carefully. That came to nothing. That came to nothing. That came to nothing. And then finally there, early this year, January something or other, it fell through the ice. And we then had this signal that lasted only a few weeks. And today, for the last 6 weeks now, the position trading long-term signal on VectorVest, which is called a confirmed call, is saying that you should be sitting in your hands, not buying any stocks, being very, very careful with the stocks that you've got. And as we go into today's trading, I am less than 40% in stocks, 60% in cash. There is one measure of the trend that is up on VectorVest, which is a medium-term swing trading methodology called the DEW. And I won't, please excuse me if I don't explain the acronym, but it gives some very simple signals, and it, in fact, is up like so. So it's a very, very mixed situation, and the front page of VectorVest says it all, that it's going to be difficult, not impossible, to find stocks that are going to go up in this environment. I think Alpesh put it so well that I think he said that an idiot could have made money in the market since March 2020. Yes, easy. And we did at VectorVest, and we made a heap. I think everybody was well pleased with that. And in this year, our objective is to develop the patience to pretty much sit in our hands and protect our capital. Your goal is to be around forever making money. And if you can be around for a long time, you can get really, 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 really good at this. Unfortunately, most people haven't got the discipline to stay away when the market is falling, and they burn and they don't get enough time to do anything. Now, the big question is this market, this is the American market, the SPX, the S&P 500. It's a leading indicator, and it's pulled back here, and it pulled back. Those of you that are Fibonacci people, have pulled back to 38% retracement. It's now trying to move up. The big question on everybody's lips is this a rally in a bear market, and are we going to topple over again, or are we going to move up and have what lots of people are calling a melt up to the upside? I think that tomorrow is an incredibly important day. The American CPI, or inflation, and markets have been going sideways all week ahead of that number. So watch out for that number tomorrow. It'll define how your portfolio does next week, I assure you. Now, I've just drawn a line chart. And ladies and gentlemen, to answer that question, if the S&P were to close above that weekly low, and that's on closing prices, not high and lows, then that would add greatly to the probability that we're going to move back up again. Now, that's an insight that I offer to customers on Monday afternoons. We get 500-600 people tuning in on Monday afternoons to listen to it from all over the world. So let's move to how to find some stocks. Well, Unisearch does all the hard work for you. And in Unisearch, you can program searches that will look at all the VectorVest metrics that you deem important to build a search that will find stocks that suit your objectives. And I put together a very safe watch list here. Now, it looks for the price is less than the value. It looks at the relative value greater than 1.25. I want the comfort index, the long-term trend, to be above 1. I want the relative safety to be above 1. I want the stock's growth rate to be above 25%, and it must either be on a buy or slugging it out sideways on a hold. And very importantly, I've sorted that by RS, bringing the top RS stocks that are above 1 to the top of the pile. And I've got this running now. It's called WBSS. What does that mean? That's Wealth Building Strategies and Secrets. It's a webcast that I do for new customers, and those are the people that are interested in VectorVest. I do that 2 or 3 times a month. It's a good place. So I'm just going to go to the program, Simon, if I may, and show you this. If I go into the program and I go to Unisearch, and I've already found it now. In Unisearch, there's dozens of searches, but I put this one under conservative because high RS searches are under conservative, and it's looking for stocks that are undervalued, stocks that are going to grow earnings strongly and safely, that are growing their earnings strongly. And I think greater than 25%, you would have to agree that that's growing earnings strongly. So VectorVest gives you answers, folks, and it will allow you to find winning stocks in a few minutes a day without employing 100 CFAs. God bless you. So if I run that search, press the button, and there they are. Tongela, Site 32, Caledonian Investments. I've taken out financial trusts. Okay, I'm just looking at companies. So I'm going to chart these very quickly. And down to here, chart them. Come on, girl. There we go. That's Tongela. It's only listed here since last September. That's when Anglo panicked, and they had to get rid of coal, put it somewhere else. So earnings per share are rising. There's the valuation up there. It's on its way. There's an analyst out there called William Delbert Gann, and he always used to say markets break on the 4th attempt. This is a textbook ascending triangle for those of you that are technicians. So that looks good. This is South 32. Now, South 32 is trending strongly, and it's on a buy, and it's about to break a new high. Its valuation is a mile above. Valuations, in fact, rising well away from the price. That looks to me as if that's got legs, folks. Know the company well. That's the old South African assets out of BHP Billiton. Caledonian Investments, terribly undervalued. Earnings per share growing strongly, and I think I would like it to break. It's on a buy recommendation. Many people say that this is in fact an investment trust, and maybe it should be somewhere else. But this rounding bottom is normally quite successful. So that's I've been speaking to everybody at the Wealth Building Seminar about James Latham. If we go back a little bit here, we can see how this is pushed up, went into this symmetrical triangle. Some people call it volatility contraction pattern. Within the triangle, earnings per share ramped up. And when earnings per share on VectorVest ramps up like that, that means that the company's done actually better than we anticipated. Similarly, if you see it ramping down, it means the share's done worse than we anticipated. This to me looks as if it's got legs, and from a technical basis, again, those of you that are technicians, if you take that and you add it to the breakout, that would give you a target up there somewhere. So that looks good to me. This is totally illiquid. We'll forget about that. That's Volatile Mining. I'm a shareholder here. I bought into it yesterday. Was a little phased when it broke this long-term trend line, but looks as if that was just a reaction. Cairn Energy, folks, look at the volume going into this. Share revalued over the last day or two. So we can find these easily. ENOG, looking very strong to me. Rising on rising volume, going sideways on falling volume, looks good to me. I particularly like the Man Group. Now, it's pulling back after a run, and it's pulling back clearly. in my humble opinion. It's pulling back to test this level to here. So it's on a buy. That looks to me as if it wants to go. But the really exciting thing about this is this huge pattern. Let's get rid of the value so we can see it. This huge, in fact, cup and handle pattern, which has got a target to hell and gone up there. That's a £1.50 target. That would take that up to about £4. Huge pattern, those of you that are technicians. So that's an aggressive portfolio. There's lots of them here. Sorry, that's a conservative portfolio. Now, I've also got an aggressive portfolio that I have for you, and just to be, it's under aggressive. And if we go down, let me see. Yeah, high flyers, DWP. There's a standard high flyers here. DWP just simply means that I've taken out financial trusts, that's all. So the sort is VST, it's a momentum sort. RT is greater than 1.25. In other words, it's already moving. So I've built in a measure of short-term momentum into this search. Relative value is greater than 1.25. I rarely look for stocks that have got an RV of less than that. I don't see the point. The stock price is about 50 pence, a reasonable volume, and it's not in financial trusts. If I run that, and I see a lot of common ground here. A lot have come, although I haven't asked for any RS, a lot of them have come up. And I can see a lot of common ground. I'm a shareholder in Shell. I've been in since £11. It's over 24 now. But there's a few that come out of this that I haven't spoken about. Let's find them. Gulf Keystone we've talked about. Cerulean Cairn we've talked about. That's illiquid. Hunting could be one that you want to look at. And the Equals Group, although it came back a bit yesterday. Let's look at all of these. I think we looked at the rest of them earlier. Now this is hunting. I've been speaking about this every Monday afternoon, but it's just now breaking a new high. It's valued at 416 up here. Earnings per share have grown flat. It's going from losing money to making money. Just remember, this is an aggressive search I'm talking about, breaking out here, but that was the level. There was the buy signal just there and moving up nicely. Now, folks, what's the target? The target on this, if you're traders, and you certainly should be a trader in this because it's an aggressive search, it's not a long-term conservative search where you want the ball to do the work. This would be a target, folks. That is 150 to 350. That's what, £2. And if you add that, that would take that to 5. Okay, that's the target in that. This is the Man Group. We talked about that a second ago. This is BP, and there was the entry point on BP, and forgive the fibs and the technical jargon, but that trend line and this old high, and there was a 62% retracement in there as well. Undervalued, growing earnings strongly, just a matter of it's starting to get high in the range here, but it looks as if it's got legs. The Mission Group, I don't like that falling tops and that. And this is Equals. I particularly like Equals, although it got headed off at the pass yesterday very strongly indeed. This came out of our what's called our Midas Touch watch list. It's come out of this watch list as well. That sell off, this used to be called Fair FX, and we'll see, as long as it stays, there's a VectorVest stop loss. I'm not in the share, but if I was in, I would have been hoped to have been in from about that level. There's the stop loss. So I hope that I've illustrated how VectorVest can find stocks for you that have got that wonderful combination of earnings growth, earnings safety if you need it, and aggressive people may not want to have it as high. Conservative people will push it up very high. Undervalued stocks that are growing, but it is a market, folks, where we only got one measure of the overall market rising. So only the most aggressive people should be buying stocks at this moment. I think that if the general market is falling, you've got to look much, much harder to find opportunity. The only opportunity would seem to be in energy at the moment. Okay, so if I go back to my PowerPoint presentation, if you want to put this together, as you probably have worked out, I've got a plan, and the plan's going to. We've been working with Simon so long. I think, Simon, they still had open outcry when we started to work together.
I think they're bringing it back. I read somewhere they're bringing it back as well.
Open outcry and hair. That's what we had in those days. We've been working with Simon for a long time. On the website, folks, a trial of VectorVest is 30 days. And because we're working with Simon, we're happy to give everybody associated with Simon and Paul a 60-day trial to VectorVest. It's a $5, and that includes all the markets of the world. And built into that, I've got a course to get you up and running. And it's going to show you how to analyze any stock in 30 seconds. It's going to show you how to manage risk. It's going to show you how to know when it's safe to be in the market and when it's not. It's going to give you cherry-picking checklists, one of which is, in fact, what I've talked about today, the more aggressive portfolio. And then a plan, how to structure a plan to keep this under control in a few minutes a day so the tail is not wagging the dog. In the US, they charge a fortune for that. But if you roll up your sleeves, you work with me for 60 days, that's what we're going to go through. It's a $5, and that includes 60 days access. That's not wrong. They wouldn't allow me to change that. I didn't know. That's a 60-day access to VectorVest, folks, and that's VectorVest World. And that includes all my webcasts, all the American webcasts. There's an 0800 number that you can phone our call center anytime, 12 o'clock midday to 12 o'clock at night. And lots of people have done this. This fella's a farmer from the north of Somerset, Minehead, I think, outside Minehead. And he's been in the market for 30 years. He's never made a cent. He's always been buying the top and panicking and selling at the bottom. It's happened to us all. Gordon Brown did it in 1999 when he sold the UK's gold right at the bottom of the market. We've all been there. The good trade is always the hard trade. As I say, if you only get one thing out of this, just remember that when you want to buy, when you have to buy, you won't want to. Folks, if it's not the best £5.95 you've ever spent, you come around to Notting Hill here, and I'll buy you a pint, or I'll give you your money back. How's that?
I think £5.95 you might struggle to buy a pint for that now.
You're quite right. It's a bargain because a pint is £6.50.
Even more of a bargain. Great, David. Thank you so much. There's questions coming in. I don't know if we're going to have time to go through them all. Will VectorVest 7 intraday be made available to UK customers? Asks Kenneth.
Yes, it will be in due course, but quite honestly, most people, in fact, lose money with intraday prices because they get nailed by the spikes. But it will be available in due course. Watching the thing, my ex-wife once told me that I was watching a chart one day, and she said that watching the bar go up and down was like going on a diet and weighing yourself every 30 seconds. For a lot of people, intraday prices cause them to lose money. So just be very careful with that. But by all means, we're working on that.
Sure. Is there any other questions? Use that link, rtc/VectorVest.co.uk/RTC. Get the 60-day trial for the £5.95, and all these questions David can address in the webinars and all the access that you've got to the team for that 2 months. And you've got obviously the whole platform there in front of you as well. Fantastic. David, thank you so much for joining us. It's been great. I know there's a lot of people here that are not people that we've seen or even known to us, because we've been out to quite a few new networks. So hopefully that's been an eye-opener for you. It's an incredible product. So hopefully
we'll do our very best to make everybody successful. But thanks for having me, sir. Paul, if you're still there, Alpesh, if you're still there, good to catch up with you at the IX show a few months back or weeks back. There's another one towards the end of the year, Simon?
25th of November. Yep.
25th of November. Okay, well, I've got it.
November, back in London, Grand Connaught Room. So
Okay.
we'll look forward to that. Fantastic. Thank you, David. Take
Cheers.
care.
Take
Speak to
care
you
now.
soon.
Bye.
There we go, David Pollard from VectorVest. That's a great offer. That was just a month's trial, but now they've doubled it to 2 months, so even better for people that are here on the webinar. Fantastic. Okay, we are heading straight along to Zahir Anwari. I've kept him waiting. I apologise, Zahir, for that. We'll add a little bit of time on to the end of your presentation to make sure that you don't miss any time. Just to welcome everybody that's still joining us, we've still got a great number of people in the room. My name is Simon Campbell. I'm hosting this all-day, all half-day summit. We do all-day events as well, so that's why it's a Freudian slip of the tongue. And it's been great fun. We've heard from Alpesh, we've heard from Paul Roberts at Stockomendation, and we've just been listening to David Paul, the MD of VectorVest. And if you have missed any of the presentations so far, don't worry, it's being recorded. You can go back and watch the replay. You'll get emailed the link, or you can go onto our YouTube channel, which is YouTube/IX Investor, and you can find it there. So let's go straight ahead. Zahir is co-founder of a company called Sublime Trading, which is an excellent and growing investment community. I'll let Zahir tell you a bit more about what he's been doing over there. But I've asked him here today to say, could you put together a list of stocks that are exciting you at the moment? Markets are difficult. This is what we're asking our speakers to do. Tell us what they're looking at and why, so you get an understanding of how they like to invest. Let me bring Zahir. I'll take the microphone off and make you the presenter so that we can get straight into it. There are just Alkesh was asking a question just at the end of David's. Does the trial include options? I'm not sure, and again, that's a question for David Paul. So jump onto the VectorVest website, and the support team there will be able to answer that question. Richard, the same as well. Does VectorVest show brokers' earnings estimates? I believe there is some sort of forecasting, one of the indicators there, but don't quote me on that. It's a few years since I was doing that in seminars. Great, let's we're making Zahir the presenter now. Zahir, I think you're self-muted, so if you can just hit the microphone symbol. There we are.
Can you hear me?
Great. Good afternoon.
Good afternoon. How are you?
I'm fine. Sorry to keep you waiting there. Let's go straight so we don't lose any more time. Just to make you the presenter, if you can share your screen.
Sure. I need. It's not. Should you be sending me over some sort of instructions to share my screen, because there's nothing coming up at the moment?
It didn't. I'm going to go back to my screen, and let me send it again to you. Something should turn up now saying confirm to share my screen.
Yeah.
Oh,
I
great.
think I can do it now.
Wonderful. Oh, that's great. Okay.
Can you see my screen? It should be. Yeah. I'm just going to do a very short presentation and then move straight into my charts.
Brilliant. Yes, fantastic. I was just saying, I invited you along because you're growing the community at Sublime Trading. I'm not going to tell people about what you do because I can't do it as well as you can, but I know it's very popular and growing. And I think in these difficult markets, this is when people could do with getting all the help they can. So we're interesting to find out what it is that you're looking at. So I'll hand over to you, Salim, Zahir, and Wari. Take it away. Thank you.
Brilliant. Thanks again, Simon, for having me. And hello, everyone. Hope you have been enjoying the webinar. I know Simon always puts wonderful events together with some wonderful speakers. So it's always a pleasure to be invited to do these presentations. So I'm just going to go straight into what I'm going to be covering today. So I'm the co-founder of Sublime Trading. And over the years, what we've understood is that people understand that the route to success becomes clearer when they have a simple system they can follow. There are a lot of systems out there. A lot of them are very inaccurate and misleading. And what I mean by that is that we first have to establish that, and I'm assuming correctly here, that everyone on here is a busy professional or a business owner. Ultimately, you have a lifestyle, married, kids, working 9 to 5, possibly longer, hobbies, etc. What you want is a system that you can adapt around your lifestyle without having to compromise on time and profit. Now, often people go down the route of day trading. I know I heard someone earlier asking about intraday trading, and I can see the appeal to that. But if you look at the stats, very, very few people are successful at intraday trading. In fact, most everyday people lose money. So we want to move away from that short-term approach and always stay true to the principles of long-term investing. Okay, now the investor journey is highly predictable, and when the problems are predictable, the solutions become predictable as well. So I'm just going to have a look at some charts. Now, this is the unsophisticated investor, someone who basically spends a lot of time chasing money, jumping around from one system to another. Often it's short-term trading and generally wasting a lot of time and money not getting anywhere. Then you have the traditional investor, someone who has, say, for example, invested into tracker funds on a monthly basis. This can work, and of course it's proven to work over the years, but at the same time, it's generally very, very, very slow growth, particularly if a bear market materializes, such as in 2000 and 2008. You can see all your profits wipe out, and then you've got to wait years for that to recover. So it does work, the traditional method of investing, but it's slow. What we want is this approach, which we call the Phoenix investor. It's where you combine proven long-term techniques using powerful current modern day investment vehicles such as spread betting accounts and CFD accounts. I'm a huge fan of spread betting accounts because ultimately they're free of capital gains tax. There's a whole load of other benefits that come with that. Now, you may already be using one, or you may actually not be using one because of some of the stats that you hear, that a lot of people lose money using leveraged accounts. And the reason for that is because of the way people are using them, usually greed as the primary driver. But if you do it correctly, and again, stay true to the principles of long-term investing, you can actually achieve some wonderful, wonderful results. And if you can compound those returns year in, year out, that's really how you will see performances that totally outperform what the market is doing. And right now we know that the S&P 500 is in a decline, but there's stocks out there that are actually performing much better than the indices, and we're going to be looking at that today, and we're going to go through how I actually find those stocks. So just a brief breakdown of what does it mean to be a Phoenix investor. Well, first of all, you have to understand market conditions. Often people don't really understand what market conditions they're in, and that's why there's a lot of confusion on how to manage your portfolio. So that's really the foundation. What market conditions are we currently dealing with? Is it a bullish market? Is it a bearish market? Is it a stand aside market? You've got to be able to understand that. The best way to establish that is by focusing on the chart, and particularly the higher time frames, the monthly, the weekly, and the daily time frames, because the charts are a source of truth. They're forcing you to focus on price. Price is a source of truth. Once you understand market conditions, and to do that, you're focusing on the charts, the next thing that you need to do is to be able to scan the market. So I like to look at the UK market, the US market, commodities, and currencies. I have a crypto portfolio as well, but that's a whole different ball game. But the main bulk of my portfolio is very much US stocks, and then of course commodities and currencies. in total, you're looking at between 8,000 to 10,000 potential assets. So out of those thousands of assets, how do you narrow down, or how do you shortlist the very best 5 to 10 that make it into your portfolio? Well, that comes from scanning. And what you're scanning for is a proven edge. Investing is a game of probabilities. It's not certainties. And I think this is sometimes where people go wrong. You can see that a lot on the internet, on social media, people talking about how you're guaranteed to make money. There's no guarantees. What there is what you require is trading or investing on a proven edge. Now, there's an expression that if you cannot define your edge, you don't have one. And if you don't have an edge, you will get eaten by someone who does. I'm just going to say that again. If you cannot define your edge, you don't have one. And if you don't have an edge, you will get eaten by someone who does. So it's important that you can define your edge. And the best way to define your edge is through technical analysis and having a few tools on your chart that can highlight and display your edge within seconds. You don't want to be staring at charts for lengthy periods of time. You should be able to look at a chart and within a few seconds know whether it's a high probability asset or not. I'm going to be sharing with you how I do this through this presentation. And then once you've gone through this process of scanning and analyzing and producing a short list, scanning and analyzing, you'll then produce a short list of stocks that are outperforming the market. And what's important here, guys, is that this process is repeatable. Day in, day out, week in, week out, year in, year out. And that goes back to what I was saying at the beginning. It's a very simple system that you can follow and that you can stick to, and that can also be adapted around your busy lifestyle. And that's crucial here. If you don't stick to a system, you'll give up. What you want is something that can integrate into your lifestyle seamlessly. And what this means is weekend analysis, weekend preparation, which will take, say, an hour. Everyone has time at the weekend if this is important for you. Your analysis starts at the weekend, and because you've done your weekend analysis, Monday to Friday should take you a few minutes a day. Okay, and this process gives you complete control over your portfolio. And also, importantly, guys, because we have spread betting accounts here in the UK, I think this is something that we're extremely blessed to have. Spread betting accounts are free of capital gains tax, 100% free of capital gains tax. So that's a reason in itself, guys, to want to learn to use them correctly. Okay, so this is really what I'm going to be covering today, the scanning process all the way down to the stocks that are currently on my list. Okay, so right now what I'm going to do, there is a screen there on spread betting, but we can come to that. What I want to do is really just go straight into, oops, excuse me, there we are. I'm going to just switch my screen over. So if Simon, if you could let me know if you can see my trading view charts.
Yes, we're now looking at the charts, which is great.
Okay, fantastic. So we'll get straight into the charts. So first of all, guys, where I like to start my analysis is by looking at the indices. Now, the primary indicator for me is the S&P 500. Whatever the S&P 500 is suggesting or doing, that really establishes market conditions for me. I do look at the NASDAQ, the Dow, and also the FTSE, but generally the S&P 500 is the primary driver for market conditions. So I'm just going to start on the monthly time frame. Now, what I've got here on the monthly time frame is the high of last year. This is this green line going across the charts, and the red line going across the charts is the low of last year. So that's the calendar year. So January to December 2021. This is the high point of last year. This is the low point of last year. What I'm looking for in a bull market is price to be trading either above the high or below the low. If you look at the S&P 500, it's currently trading in between these two levels. And the fact that we're seeing a correction shouldn't really be of any surprise. First of all, the stock market's been on this huge bull run since 2009. That's the low here. And that's a bull run of, if you take it to the very high point, that's a bull run of over 600%. Now, during that bull run, there have been corrections along the way, notably that correction around Corona, which was a decline of around 35%, if I remember correctly, at 35%, to the low of March 2020. And then the bulls came in and pushed price back up. So even Corona was absorbed into this long-term trend. Now, whether, this sort of current decline that we're in, I mentioned earlier, it was currently around 14%. At its very low, it was 20%. Whether this materializes into a full-on bear trend like we had in 2000, there's this bear trend here in 2000, then we had another bear trend in 2008. It remains to be seen. The overall bias for now is bullish, and that's because the stock market in general is bullish. Currently, I'm simply standing aside and waiting for a clearer direction to the market. Now, let's just look at this in a little bit more detail, guys. If we just go back to last month, which was May, we can see that May ended as an indecision candle at the 4,000 round number. This is important because an indecision candle at a at a major level of support could potentially end this pullback, and we could see a reversal back to the upside. Of course, at the moment, we're seeing a bit of bearishness in June, but overall, my bias for now still remains bullish until price dictates otherwise. Now, let's go on to the weekly and the daily time frame. I'm going to open up the weekly time frame. On the weekly time frame, I've got the 200 moving average, which is the black line. I've got the 50 simple moving average, which is the orange line. And I've got a trend filter on here. If you notice, I don't have just green and red bars. I've got green, gray, and red. So when the market's bullish, we predominantly see green bars above the 50 and the 200 moving average. What this means is that price is trading better than the average. As I said earlier, the S&P 500, all the indices, they're averages. So whenever you're looking for a high probability environment, you're looking for price to be performing better than the average. It was here that the S&P 500 was performing better than the average, the 50 and the 200. However, since the start of the year, we've been in a bit of a correction. But this doesn't mean that we're in a full-on bear trend. I think this is where a lot of people sort of panic. And often that goes back to the beginning, which is there's no system, there's no understanding of market conditions, there's no alignment with the natural movement to price. Also notice that the trend filter is alternating between red and gray. When the trend filter is alternating between red and gray, what that means is that we're not in a full-on bear market. We want to see a lot more red bars rather than a mixture of red and gray. So this for me is a consolidating market for now. Price is trading between the 50 and the 200 moving averages. If price broke below the weekly 200 moving average, then I may consider shorting the market as a whole. Okay, and let's go down to the daily time frame. Okay, on the daily time frame, we've got price below the 200 moving average, we've got price below the 50 simple moving average, but price is currently trading above the 20 simple moving average. So again, and the trend filter, if you notice, is now green and gray, suggesting that we could be seeing early signs of bullishness. Overall, guys, what does this suggest? To me, this suggests that we're in this environment where we're neither overall bullish, we're neither overall bearish. We got to be standing aside. Yes, the long-term trend is bullish, but we don't want to be jumping in just as yet because we want to see confirmation of further strength. And the earliest for me really is if price moves back above the 200 moving average. That's when I will start considering adding bullish stocks back into my portfolio. Now, there are a number of stocks that I'm still holding on to. Just to give you an example of some of the stocks that are in my portfolio. These aren't the stocks that I'm covering today, but just to give you an idea, McKesson Corporation, you can see how well it's performed. While the S&P 500 has been dropping, while the indices in general have been dropping, McKesson Corporation has been performing really, really well. Another one is Amerisource, another US stock. While the S&P 500 has been dropping, the Amerisource has been performing quite well. It is going through a bit of a correction, but that's expected. You can't expect price to continuously print new highs. Okay, so just to go back to my list. Okay, so we've got the S&P 500. A quick look at the NASDAQ. Again, you can see the NASDAQ, just going to focus on the monthly time frames, trading inside the annual levels of last year. Again, no clear bear market as yet. If it breaks below the low of last year, then potentially we could be in a much clearer bear market. For now, we're inside the annual levels of last year, and that for me is more of a sideways market rather than a full-on bear market. It's certainly not a bull market until, as already mentioned, we move above the 200 moving average. The Dow Jones, very similar. You can see again trading inside the annual levels of last year. So once again, a market where we want to be potentially standing aside on. And I'm just going to have a quick look at the FTSE. I don't pay too much attention to the FTSE, but we can see the FTSE actually has been performing really well. It's been pushing higher and higher. If it breaks through these resistance levels ahead, then we could see price move beyond 8,000. So for now, again, where are we? We're kind of stuck between resistance and support. So remember, guys, patience is a key skill of a good investor, and it's a skill that's often underappreciated with people always wanting to chase money. There's a time to be standing aside, and there's a time to be active in the market. The foundation really of an investor is to protect your capital. A good investor always focuses on capital protection and lets the profit come to them. These current market conditions, you just got to be a little bit careful about how you allocate risk. Okay, so that's the first thing, guys. I like to look at the S&P 500 and the other indices and sort of get a general idea of what the market is doing. The indices are an average. The S&P 500 is an average of 500 stocks. The NASDAQ, an average of 100 stocks. The Dow, an average of 30 stocks. So logic should prevail that if the indices are an average, and if you invest in the average, you'll get average results. However, if you have a process that can pick out stocks that are performing better than the average, for example, McKesson Corporation, then your portfolio will perform better than the average. So once I've looked at the indices, what I like to do next is to look at the sectors within the S&P 500. So let's just have a quick look at how the sectors are performing. If you look at energy has been performing really, really well, especially in the last sort of couple of months when most of the other sectors have been either consolidating or tanking. The S&P 500 energy sector has been performing really well. So it should be no surprise that a lot of the stocks that I'm going to be sharing with you today are actually from the energy sector. So what I do is I look at the sectors, I look at which sectors are performing the best. I then scan within the sectors for the best performing stocks within that sector. I hope that's clear. I'm going to say that one more time. I look at the indices for overall market conditions. I then look at the sectors and I look at how the sectors are performing. The strongest sectors, I then go in there and look for the strongest stocks in the strongest sectors. And that's how I'm constantly being able to add the best performing stocks into my portfolio. Okay, so if you look at the energy sector, doing very well. You compare that to financials, no surprise, financials is not doing so well in recent months. If we look at healthcare, healthcare is actually not doing too bad. It's in a bit of a consolidation at the moment, but some of the stocks in my portfolio are actually in the healthcare sector. So healthcare is actually doing okay. Utilities, again, not doing too badly, stuck in this sort of area of consolidation at the moment. Industrials, taking a bit of a tank in recent months, but again, I wouldn't say it's doing too badly, just not as well as the energy sector, quite clearly. Real estate hasn't been doing well at all. We can see that real estate has taken a bit of a hit. Materials, not doing too badly, kind of stuck in this area of consolidation, so not doing too badly. Some of the stocks that we're looking at are in materials. Now, the tech sector, of course, as you all know, that's taken a bit of a hit, but that's not a surprise. If you look at how well the tech sector has done since the recovery from Corona, since the recovery from COVID-19, there was bound to be some kind of correction in the tech market. And that's really where your exit management comes in, your trailing stop losses come in, because you can't expect stocks to just continuously create new highs. They go on a run, each stock may add 5 to 10% in your portfolio. If you've got 5, 6, 7 tech stocks that are performing very well, at some point the reversals come in, your trailing stop losses get hit, you take your profit, you then replace those stocks with stocks from the energy sector, because those are the ones that are doing well. That's the basis of managing a portfolio. Don't get obsessed with a single stock or a ticker symbol. Be neutral and move between the trends in the market. Okay, so that's the tech sector. And consumer staples, not doing too badly, a bit of a hit in the last couple of months, but okay, overall. Consumer discretionary, people potentially have less money to spend, so of course there's less going out, so who knows the reasons behind this. But consumer discretionary has taken a bit of a hit, and communication services, well, they've been on a real decline, but they may be finding some kind of support now around the 200 round number, so we could potentially be seeing a move to the upside. So that is the sectors. So we've looked at the sectors, and now that we've looked at the sectors, we now want to look at the stocks that are that are performing the best. So let's look at some of the stocks. So this is my stock list. Most of these are US stocks. I think there's a UK stock in there, but let's look at COP, ConocoPhillips. Okay, first of all, we can see that ConocoPhillips has the potential to perform very well. It's done it in the past. You can see here a good run to the upside, a good run to the upside. So one of the first things that I like to look at is how well a stock has performed in the past. If it's performed well in the past, then it's likely to perform well in the future. So Conoco, it has a history of performance. If you look at what it's doing now, it's printing new all-time highs. The S&P, the indices, they're all dropping, whereas these stocks are pushing higher. That's another signal that we're not quite in a bear trend just as yet. If there's stocks pushing higher, then you've got to be wary about jumping in too early into a bear market, because some of these stocks could really go on to reach new highs, and then the market as a whole could follow. If we look at the weekly time frame, on the weekly time frame, price above the 200 and the 50 simple moving averages, the trend filter is green. So again, you can see this stock is performing better than the averages. And on the daily, price above all three moving averages, the trend filter is green. So this is what you call a high probability stock. Now, of course, there are no guarantees what could happen next, but the chances are of this stock pushing on to new highs is great. That's because the market is performing really well. So this is one of the stocks that I'm looking at. The next, Chevron. Again, if you look at the monthly time frame, performing well, producing new highs above the high of last year. It was likely to move towards $200. It's got a history of performance. It can be a little bit bumpy, but that's all part and parcel of every stock. Look at periods where it's trended, when the reversals come in, take your profit, stand aside. So for example, if we look at Chevron Corporation, the high of this point here was 2014. If we go here, the high is 2014. So from 2014 to this year, 2022, that's what, 7-8 years? This wouldn't have featured, if you were smart, this wouldn't have featured in your portfolio because it hasn't gone anywhere. Now that it's broken out and it's printing new highs, it's one that you want to monitor. Okay, so again, looking at the weekly, you can see that it's moving, it's above the averages, it's performing well. On the daily, above the averages, performing well as well. So we've got Chevron. Next stock is EOG Resources. Again, you can see that it's performing very well, breaking out, printing new highs. Now, what's good about this is that it's only just breaking out. So if you can get in early at the base of a breakout, this is where you will catch the bulk of the moves. Remember, guys, you're not going to make money at the beginning of the trend because it's very difficult to pinpoint the start of a trend. Usually when the reversals come in, you'll give back a bit of profit, but it's the bulk, the middle of the trend where most of the damage is done. So that's where you want to hold and you want to compound. If you look at the weekly, it's above the moving averages, the trend filter is green, and on the daily, excuse me, guys, price is above the moving averages, the trend filter is green as well. So again, a stock that has a very high chance of returning profit. Okay, next, Diamondback Energy. It's got a ticker symbol FANG. If you look at the history, again, good performance, bit of a correction, created a base, and is now recovering, breaking out, and is likely to push towards $200. On the weekly, above the averages, the trend filter is green, and on the daily, above the averages, the trend filter is green. Now, I hope you guys are seeing how quick it is to analyze these stocks. I mean, in about 2 minutes, we've gone through, I think this is my fourth stock. In less than half an hour, we've looked at the indices, we've looked at the sectors, we're looking at stocks. This is how simple, I'm not easy is the wrong word. This is how simple it should be to analyze stocks, analyze any chart. You can bring up a currency, you can bring up a commodity. It should be really simple to analyze the chart. Where the challenge comes in for most people is extracting profit. If you're good at analysis, guys, you're an analyst. If you're struggling to make money, then you're not very good at investing. What you want to do is be good at analyzing stocks and then good at extracting profit. So you want to translate your analysis into profit. And that's where strategy comes in. Understanding entry points, risk management, stop losses, compound levels, trailing stop losses. applying patience, the psychology of trading, all of these elements that go into making an investor. People tend to overlook that. There is an element of sophistication to it. All of these techniques are actually very simple to learn, but again, extracting profit can be a challenge. Okay, next stock, FCN. Again, ticker symbol is different to its name, which is FTI Consulting. Excuse me, monthly, we can see that it's now pushing to new highs, performing really well at the moment. On the weekly, it's above the averages. The trend filter is green, and on the daily, it's above the averages. Let me just open that up. It's above the averages. The trend filter still a little bit bumpy. So this is a stock that you don't want to get in just as yet. You want to see a little bit more in the trend, a little bit more confirmation. If I start seeing price produce more of a linear trend, then this could be one that I could make it into my portfolio, particularly as it's only now just breaking out and creating new highs on the monthly time frame. I really do like to get in on stocks that are breaking out right at a base, and the base acts as a foundation for a trend to develop. Okay, this is a stock actually that I recommended as a stock of the month for my community, and you can see why. Performing very, very well at the moment. Since it broke out and printed new highs, it's moved about 27-28%. It's above $100, so it's still a fairly cheap stock as well. On the weekly, price above the 250 simple moving averages. The trend filter is green, and if you look at the trend in play, guys, this is what we want for a good trend. If we just go back to FCN, you can see how FCN is a little bit jerky at the moment, a little bit bumpy. But if we come to MPC, can see how well this trend is performing. This is what is known as linearity, where you've got a nice clean trend. It's being supported by the 20 and the 50 simple moving averages. The pullbacks generally come in between the 20 and the 50 simple moving averages. You can see it here, again here. This is what you look for in a good trend. Linearity is the word that you want to be looking for. MTDR, another stock. Now, I quite like the look of this stock. The reason for this is because you can see it's performed really well since the low of March 2020. That was around COVID. It's still a cheap stock. It's only around $60. I mean, at the end of the day, a price of a stock doesn't really make that much difference. I mean, Amazon's a really good example. You could get into a stock at $500 and it could go to $3,000. But it's a bit difficult when it comes to position sizing. The cheaper stocks give you more bang for your buck. So your 2% risk will make you more money on a cheaper stock. So this is a really good example of a stock that I'm looking at. It's still around that $65, $66 mark. It's got a performance here of doing well. It's printing new all-time highs. On the weekly, it's above the averages. The trend filter is green. On the daily, price above the averages. The trend filter is green. Again, fairly new in the sense that it's the 20 and the 50s only just crossed over. The trend filters only just turned green after this sort of correction in the market. So you may want to see a little bit more in the trend, so a pullback and a breakout before entering into the stock. Now, also, guys, remember the indices are declining. So you've got two options here: either stand aside and wait for a recovery in the indices, or if you are going to take positions on stocks, make sure you reduce your risk. So in optimal market conditions, I may risk 2% per stock. Whereas in market conditions like this, if I decide to take a position, it may be a quarter of a percent or 0.5%. So do be aware of how you manage your risk in market conditions where the indices aren't clearly defining a direction. Okay, next is PGR. Again, I mean, this is a very, very good looking stock. You can see how well it's performed, its history. Again, fairly cheap stock, you know, around that $120 mark, only just breaking out, printing new highs. On the weekly, price above the averages, the trend filter is green. And on the daily, price above the averages, the trend filter is green, bit of gray today. Again, very early in terms of taking a position. We want to see a little bit more in the trend. So maybe a breakout or pullback, another breakout before looking to get into a stock like this. Patience, again, at the beginning, what I said is that patience is an important skill. And sometimes the skill that people tend to overlook. But if you apply patience, you'll be very well rewarded. Two ways. First of all, you'll avoid losses by getting in too early. And secondly, by applying patience, you get in when the probabilities are very much in your favor, and you'll catch up with lost time through compounding. People often don't experience the strength of compounding, and because they don't experience the strength of compounding, they don't really appreciate what compounding can do for you. But if you give compounding a chance, it'll change your whole outlook of how to invest. You know, day trading will be a complete thing of the past, because with day trading, you're doing a lot of work for inconsistent profit. Whereas with investing, trend following, holding, and compounding, you're doing far less work for unbelievable growth. Okay, and the final stock we'll look at, this is another stock that's looking quite interesting. I think it's pronounced Valero or Valero. I think it's Valero Energy Corporation. Again, you can see performing really well in recent months, breaking out, creating new all-time highs. On the weekly, price above the averages, the trend filter is green. And on the daily, price above all three moving averages, the trend filter is green. Again, if you look at this a trend in play, linearity, see how well it's performing, being supported by the 20 and the 50 simple moving averages. This is what you're looking for in a stock. So you can imagine if you got in at this position here and all you did was hold your position, you know, this is a move of 50% in your favor. So this is what you're looking for, guys. You're looking for these stocks that are outperforming the market. Okay, so before I end the presentation, I'm just conscious of time. I'm going to switch over to Simon, and I'm going to ask Simon if there are any questions.
Thank you, Zahir. Yes, we're just about out of time, but yes, a few questions there. If we can just spend maybe 1 minute. Stephen, I know you're here already, which is great. We've just run about 5 minutes behind for the last 2 hours, so if you're okay to hold on just a few minutes, we'll wrap up these questions with Zahir. First of all, how do you pick the top performing stocks within a particular sector? Zahir, that's from Mabs.
Yeah, I mean, everything that I've shown you today is the way I have done it. So scanning and looking for stocks that are meeting that checklist that I've just established. Monthly, printing new highs, weekly above the averages, daily above the averages, looking at the history of the performance of the stock. So there is an element of getting your eye into this. You know, it's not just a case of just pulling a name out of a hat. You've got to create that initial shortlist, and then say that initial shortlist has 20 stocks on there. You then go through that initial stock, that shortlist, and then pick out the best 5 that make it into your portfolio. It takes a bit of time and experience, but it's not difficult.
Carwin says he likes your strategy, or do you have a preference between US and UK, or do you just trade the US?
Well, I mean, US is always really, US makes the bulk of my portfolio just because of the way it performs and the sheer number of stocks in that market that trend really, really well. You know, in the past, I've traded UK stocks. Boohoo's done well for me. JD Sports has done well for me. Polar Capital Trust, SMT, Scottish Mortgage Trust. So there are definitely some good performers in the UK stock market, but US stocks by far the better market.
A lot more to choose from as well. Amma says, so looking at your style of trading, how do you time your entry on these trades, especially when the distance between the price and the moving averages are quite large in a bullish scenario?
So how do I time the market when my checklist is met? So there's an element of just looking. What people want to do is sort of remove this idea of being perfect with their timing. You don't want to be perfect with your timing. You want to have a checklist. If that checklist is met, that's when when you enter into the market. If the checklist isn't met, you stand aside.
Okay. So here, could you mention the hot vault, the hot stocks vault? I've got a link. You've given me a special link for a 30-day trial for people here. I don't want to move on without mentioning that.
Sure. Can you guys, can you see my screen?
I can see that, yeah.
Perfect. Okay, so I've given Simon the link. We have created the hot stocks vault. So everything that I have covered today, you will understand in a lot more detail. So if you go to that link and register by clicking join now, and if you use the Simon 30 code, not only will you get a 30-day free trial to the hot stocks vault, but you will also get a 50% discount on the price for the first year. So what does the hot stocks vault involve? Well, it's basically a list of the top 10 performing stocks 3 times a week. So Monday, Wednesday, Friday. You also get a stock of the month. You also get a video syllabus that explains how to do your analysis. So everything that I've covered in today is covered in more detail in the video syllabus. And the page that I just used to do my analysis, all the tools that are on that page, the trend filter, the highs and lows, the moving averages, etc. It's all already set up for you to clone and for you to also have free access for 30 days. It will require you to have a membership to TradingView, which is the software that we use. But again, TradingView is free for 30 days. And then I believe it's something like £200 or £250 for the whole year. So it's amazingly priced and very, very cheap. So you get free access to the charts as well for 30 days. So once again, it's a 30-day free trial to the Hot Stocks Vault. Simon's got the link. Click on that, come through. And then at the end of your 30 days, when you use the Simon30 code, when you first register, you will automatically roll over onto a 50% discount.
Fantastic. Okay, Zahir, we'll have to stop it there. I'm sorry. It's been a fantastic presentation. I'd like you got right through lots of different stocks. We appreciate that. Claire's just asking, is there a minimum investment for this?
You mean in your account, in your bank account, in your broker account? I mean, look, guys,
Yeah.
really want a good starting amount is about £10,000, because anything less than £10,000 makes it very, very difficult to manage your risk. The more money you have, the better you can manage your risk. So £10,000 is a really good starting amount.
Brilliant. There are some other questions, but we'll have to stop it there. I'm so sorry. You can catch up on the replay.
Simon, people can reach out to me at zahir@sublimetrading.io. So any further questions, please reach out to me. Thank you, Simon, for today.
Fantastic. Zahir and Warren, Sublime Trading, thank you very much indeed. Okay, so we are already at our final speaker of the day. Hello, and where's my screen gone? Make me the presenter. No, don't know how to do that. Well, you should be able to see my screen. Hopefully you're looking at today's agenda and you can see that we are just at after our 4:30 time slot for what's next for growth stocks. And I'm really pleased to say that we have Stephen Clapham. Stephen is the founder of Behind the Balance Sheet, which trains city analysts and bankers into how to analyze stocks for professional trading floors. He has run hedge funds in the city, a long distinguished career in the city, so he's just slightly qualified to be able to tell us what's going on in the markets. So I'm really pleased that he's here, and of course there is a book as well which Stephen published. I'm sure he'll tell you about that as well. You can contact that through Harriman House, the financial publisher. Stephen, I will unmute you and say good afternoon.
Can you hear me?
Yes, I can hear you.
Can you see me?
Now, I can't see you, but I'm not sure I'm on the right screen.
All right, don't worry. How do I share my screen, Simon? That's the one thing I don't know how to do.
We haven't done that yet. I'm just about to send you a command now.
All right.
So when you click that button there, excellent.
So can you see my slide?
We can see the slide. It's not in full presentation up, but it is now. Excellent. Yeah,
Cool.
yeah, fantastic.
Well, thanks. I'll go quite quickly. Thanks because you're starting late. You don't want to finish late. Quite funny. I was listening to the previous speaker, and Valero, the US refiner, of course, there's a shortage of refining capacity in the States. It's one of these things that we've been talking about on my podcast and in the newsletter about the capital cycle and the fact that the energy stocks have been starved of investment. So the US doesn't have enough refining capacity, which is why Valero, which is a very volatile, very difficult stock for an analyst. And the other one I liked was FTI Consulting, because I've this week, Simon, I had a podcast recording with Dan McCrum, the investigative journalist who blew apart Wirecard, and his book is out on Thursday, and my podcast interview with him is out on Thursday. And in the book, he names FTI Consulting, who were acting for Wirecard. Wirecard was doing all sorts of naughty things. So that was two things that came out. But let me just tell you a bit about me. I was a partner, head of research at 2 multi-billion-dollar hedge funds. Simon kindly said I had a distinguished career. I don't know how distinguished it was, but I'm no longer in hedge funds. I set up a training business, and we've got on the website, we've got loads of free stuff, which if you're interested in investing, and particularly the practice of long-term investing, the new website's got a load of material. I mean, just tons of material. You need to go to the investing resources, investor content hub. There's a library, there's fund letters, there's free videos, there's all sorts of stuff, including a set of top 20 podcasts, top 20 newsletters. And you can see one of the top 20 is my podcast, Behind the Balance Sheet, which had a load of really good guests. So please do have a listen. And if you feel like subscribing and feel like leaving a 5-star review on Apple Podcasts, that's always appreciated. We've got a YouTube channel with lots of interesting, useful investing tips. And I've just started a newsletter. I started at the end of March, beginning of April. It's been pretty popular. We've had a load of interesting articles, including, you can see at the bottom there, Naughty Netflix. And Netflix is one of the stocks I'm going to talk about. But just before I get to that, I just want to tell you the reason I'm here is I'm in the business of selling online training courses, and you can get that on the website. Our most popular course is at Analyst Academy. It's a really excellent, fantastic course. And if anybody's interested, you can shoot me an email and I'll tell you about it. And that's the book, The Smart Money Method, Amazon #1 investing bestseller. And that's where you can get hold of me. The website's behindthebalancesheet.com. My email is info@behindthebalancesheet.com. And I'm on Twitter @Steve Clapham. So what I want to talk about is value versus growth. And this is a little bit out of date. I couldn't find a more up-to-date chart, but you can see here that there was a record number of stocks, or proportion of stocks, trading at high above 25 times multiples. And I'm going to show you a few different charts of growth versus value. This is Wilshire, so this includes the small caps. And you can see that there, the valuations aren't as high. The relative growth to value isn't as high as it was in the dot-com boom, but it is for the larger companies. This shows you that value has started to catch up a bit on growth, but the growth has still done 10% better since the start of 2021, so the start of last year, the last 18 months. The drawdown for value has been much, much lower than it has for growth. Growth's obviously bounced back very dramatically in the last couple of weeks. But these are some charts looking at the S&P 500, which tends to be the thing that I look at more closely. And you can see here that in the dot-com boom, it was the smaller stocks, so the very speculative things that went really through the roof. And the weight of the FAMANG, or however you want to, MAMAN now, I think is the new acronym as Facebook's changed its name this week. You can see that the growth to value has been very dramatically higher, and the correction has been very, very significant in the last 6 months, since November of last year. Here is the earnings growth, and this is the relationship of growth to value. And you can see that growth is still doing, I mean, it's come off the top, but it's still showing much better growth than value, which is what you would expect, right? Because that's one's growth, one's value, right? But here's the forward PE ratios, and this I think is quite a dramatic, really a dramatic reduction in the valuation of the growth stocks. Now, the value stocks are still quite cheap, but the premium really isn't that high for the growth stocks. So what I'm going to tell you is that, it's not the end of the road for growth. clearly value is going to have the upper hand for, I think, for the next several years. But I think you can still make money in growth stocks. Now, this is a very slightly controversial view, because there's lots of people that think value is here and growth is dead. I'm not as black and white as that, having seen this in particular, because I think, and I've seen some, pretty decent growth stocks which I don't think are stupidly priced. So here is the relative PE, and again, you can see the impact of the last 6 months correction. Obviously, we've had a 5-year re-rating of growth relative to value, because interest rates have gone through the floor, and interest rates haven't gone back up through the ceiling, and they won't go back up through the ceiling. So there is scope. And here is just a longer term look at what happened. So you can see in the dot-com boom, you can see how dramatically growth outperformed and how dramatically value underperformed. You can see that there's been a long period since the global financial crisis in which people have not wanted to own value stocks, and they've only wanted to own growth stocks. And you can see those crocodile jaws coming together here, but they're still a long way apart, right? So in the 1970s, what you saw, so in the 1970s, the last period in which you were in an inflationary environment, we're clearly in an inflationary environment again. And what you saw then was that Nifty 50 was destroyed. I'm not expecting a repeat of that. The messages are mixed, and it depends on the earnings outlook for growth. And people who believe in growth stocks believe that earnings outlook is fantastic. And if you're like me and you're a pragmatist, you should be more realistic, because lower disposable income, let's be clear about this. What we're looking at is a period of the next 18 months in which people's incomes in the UK, in the US, are going to get squeezed. And lower disposable income affects growth companies as well as everybody else. Inflation is a pernicious tax. It's most oppressive on the lower paid. And these growth stocks are not immune. So what you're going to see is lower advertising spend. That is going to affect Google, part of Alphabet. It's going to affect Facebook, part of Meta, and it's going to affect Snap. You've already seen small correction in Alphabet, big correction in Facebook stroke Meta, and a big correction last week in Snap. Lower disposable income. In the 70s, we didn't have subscription products like Netflix. Netflix is going to be hurt by this, but so is Disney, so is Amazon, and so is Apple. Apple, in particular, I think is going to be hurt by trading down. Because if you're in an environment in which people's incomes are being squeezed, they're not going to spend $1,000 on a new iPhone, they're going to wait. That is going to be an issue for Apple, because it's a very upmarket brand. Of these big tech stocks, Microsoft is probably the least vulnerable to this discretionary spend slowdown. Of course, it's just spending $76 billion in Activision, and Activision is very, very exposed to that. So I want to talk a little more about Netflix, and just to say, all of this is not investment advice. These are my opinions. Please do your own research, and the full disclaimer is on my website. And if you manage to read that full disclaimer, a prize, because it is very long. Just a backdrop to this, I've been critical of Netflix accounting for some time. I've published 3 blogs on it. I think the first one was in 2019 rather than 2020. I've been critical of the stock price for over 12 months. And the points that I've been making is that Netflix's single largest cost is for content. And it accounts for the content by depreciating it over 4 years to 90% of its original cost. And I don't see that that policy is being correctly applied in the financial statements, because as you can see here, the life of the content has gone from 3 years to 7 years. There are some adjustments you can make to this, but it's a simple thing. And here, what I've done is I've projected what Netflix's amortization would be if it wrote off a cost of the content over 4 years to 90% in a straight line. Now, what Netflix do is they amortize the content based on actual viewing hours as a percentage of the estimated viewing hours. So when a new release comes, that's when everybody watches it. And that's when the amortization kicks in. It should be weighted to the release date, to the early years. And you can see from this that Netflix is almost exactly the straight line 25% per annum. So there's something wrong with Netflix's accounting policy, or there's something wrong that they've assumed that the life of these products is going to be much longer. So I think that there's a basic problem in the content accounting. This is Netflix's share price to the top from the start. That's it, 2015 to 2021. So you've done really well. But obviously it's collapsed. These charts are a bit out of date, but it's still pretty around this share price. And you can see, as always, the fall is faster than the rise. And I think the important point here is that people don't have profits in Netflix unless they bought it 5 years ago. And I suspect that a lot of the Netflix holders are more recent than that. So they're all sitting in losses and they're wondering what to do. But the last time Netflix was around this level was the start of 2018, when it had roughly half the number of subscribers that it had today. And I think many people are very puzzled that the fact that when it forecast that subscriber numbers would fall by just by 1%, the shares fell by 40%. And that is typical of these growth stocks. This is the share price in the last 6 months. And this is, I think, more interesting, the market cap. If you look at it in market cap terms, you can see that at the top, it was, and you can see that lovely double top formation, it was valued at $300 billion. I mean, that is a massive amount of money. And that assumes a blue sky scenario, a valuation of $100 billion, much more realistic. And when you look at the valuation, you can look at it in different ways. You can look at it on PE, but Netflix was trading in daft multiples. It's now trading on a more sensible multiple of 20 times. People were looking at it on EV/EBITDA, but that EV/EBITDA number is a daft way of looking at it because it excludes the cost of the content. You wouldn't look at the valuation of a restaurant without including the cost of the food, and that's what you're doing here. So that's a silly way to look at it. You should look at it on EV to sales. And on EV to sales, it's now trading on 3 times sales, which some people think is a cheap valuation. If you want to look at this, you've got to look at the sales growth and you've got to look at the margins. And my whole point on this is I don't think that Netflix is in a good position to grow its revenue. Yes, it can grow in Asia, but a customer in India is worth probably 10% of a customer in the UK. Price rises in the West are going to help, but they're going to be massively dilutive because they're going to create more churn at a time that people's incomes are under pressure. They're talking about charging people for password sharing. They're saying that there's 100 million people, I think they said 30 million of them in the US and Canada, who are sharing passwords illegally, and they're going to charge for that. Well, I think that's ludicrous, because I think if you allow me to share my password with Simon, we're going to share our passwords and we're each going to take a benefit because we're going to have a 60% discount in the cost. So we're going to share that. I don't think that is, I think that's going to really backfire in Netflix. What I do think is going to work is the ad-supported service, because I think a lower level subscription will allow people to trade down. And I think the ads will make it equivalent to the higher level subscription value to the company. So I think that's a really good idea. Growth is still possible, but certainly not on the previous expected trajectory. I think, you know, growth is going to be a struggle. And this is what people were assuming for Netflix's sales growth, 10% per annum. And this is Netflix revenue forecast going back to before the pandemic. And you can see that the forecast for the next 12 months are going up very nicely as you move forward over time. But if you look at the 24 consensus for revenue, it's actually moved down since the pandemic, in spite of that 40% hike in the number of subscribers. This is the consensus revenue for 2024 from start before the pandemic and now. It's 10% lower today than it was before the pandemic. So, you know, the pandemic has certainly helped in bringing forward customers, bringing forward revenues, but I don't think it's ever actually changed the number of customers that Netflix was likely to attract. It's brought forward revenues. And then you've got to think about what margins Netflix is going to make. This was the consensus before all these downgrades came through that Netflix was going to get to 25% margin. And that is probably going to be closer to 20% now, which maybe makes the 3 times sales not blue sky, but possible. But that accepts Netflix accounting policies, which we disagree with. And we think that the real margin at Netflix is closer to 5%. Because if you take the cash cost of the content, and over time, the cash cost of the content will be what counts, it's not making 20+%, it's making mid-single digits, maybe could get to 10%. So all that is to say, Netflix isn't going to make a 20% cash margin, and if the subscriber churn increases, it's going to be in trouble. This is Bill Ackman. He was incredibly stupid to buy Netflix in January. He may not be so stupid to cut now, although he has lost, I think, as much as $500 million. We've seen very sharp sell-offs in Meta. We've seen very sharp sell-offs in Snap. These show that these stocks are very vulnerable to even very small changes in earnings and outlook. So we're seeing big changes in sentiment. And the thing to take away, I think, Simon, is that these stocks are still very well owned. Lots of people own these companies, whether it's retail or professional. They're over-owned. And obviously, you know, people say, how can a stock be over-owned? Because, you know, these stocks are held internationally. They're not just held in US accounts. But I think there's a lot of fund managers who have made a lot of money over the last couple of years in these growth stocks, and they're now going to want to cut their exposure. So I think that the sentiment, the technical situation is going to be against them. I'm going to leave it there just in case there are any questions. Simon?
Stephen, thank you very much indeed. What a great presentation. Is there, before we get to the questions, over your shoulder, there are some, is that projector wheels on the wall? Is there a connection with Netflix?
What, this here?
On the wall, are these from old movie reels?
Oh, yeah, these are movie reels. So I'm in the edit suite. So
okay.
So my new office, Simon. So I don't know if you've seen this before, but my new office, upstairs is a podcast studio. So we were in there this morning, and this is the edit suite where we do all the changes.
I see. I thought it was maybe a slight Netflix connection there with the movies.
No.
So you're being very clever there. Oh, fantastic. Listen, thank you so much for that. Lots to think about there, for sure. Does anybody have any questions for Stephen? There we are. We're starting to get some questions coming through. Ben is saying, what are your favorite fundamentals on a stock pick?
Well, I don't know that I've got favorite fundamentals. I mean, you know, I tend to look, you know, I'm a financial analyst, right? So I start with financial statements. I start with the 10K or the reporting accounts, and I base everything around that. And, you know, that's my philosophy. That's what I teach in my training courses. But I think if you understand the financial statements, you're never going to get caught in a fraud or something with accounting shenanigans. And, you know, my starting point is the way to win is to try not to lose money. And that's my, you know, that's my approach. But I think, you know, that's not the only approach. You can make money in investing in all sorts of ways, but that's firmly my starting point. So I start with the reporting accounts, and I look and make sure, is the company generating cash? Is it making margins that make sense? And it's not giving away too much in stock-based comp or you know, the management taking all the money, and are the management honest? And I've got a whole checklist of things, which obviously we don't have time to talk about, but I really do believe that you should start with the financial statements, because then you're safe.
Stick with financial statements. What about valuing a growth stock? We've obviously just been talking about this in context of Netflix. You say you have to include the cost of the you know, making the movies or making the dinners. So
I think the key thing everybody misses with the growth stocks is, so they're all busy looking at the revenues and they're projecting them growing to the sky. And of course, Amazon has confounded all history by growing faster than any large company ever has before. And I think, you know, you have to think about now, you know, Alphabet, obviously search is a very powerful tool, but, you know, how much is advertising going to grow? And you've got to think about, you know, are the previous growth rates, which have been boosted by COVID, are they going to be maintainable? And you've got to look at, you know, the same thing applies to a Facebook or a Snap. But the valuation, the one thing I think everybody gets wrong with the growth stocks is there's a huge amount of stock-based compensation. And in the newsletter now, we're doing a series on stock-based comp, because I think, you know, people ignore it. And, you know, if you get diluted by 3% per annum over 10 years, that's, you know, huge. So we're sitting in 2022 and 3% of the stock goes out every year. By the end of 2032, we own less than 70% of the company. And that makes a huge difference to your returns. And people don't, I don't think people properly factor that in.
I don't think they would either. It's not something that occurs to most investors. Does Stephen estimate future earnings of PLC shares?
Future earnings of
PLC shares?
Yeah, I mean, when I was a professional analyst at the hedge funds, then, you know, my main job was to try and find opportunities where the stock market, the sell side consensus forecasts were wrong. And, you know, there were lots of instances of that, and where we could have very, very high confidence that company was going to make a lot less or a lot more than the street was assuming. And that's what I did. That's all, you know, I didn't worry too much about valuation. I didn't worry too much about the charts. I didn't, you know, I just said, I think in 2 years' time, this company is going to make twice what the stock market believes, or half what the stock market believes. And if you get that right, you make a ton of money. Because if it makes twice what people think, then, you know, the estimates keep going up, but the rating also goes up. And if it misses, the stock craters, because nobody wants it. So, you know, it's a very simple strategy. I mean, you know, it's simple to describe. It's less easy to execute, but it's a very, very consistent thing. And I would say to anybody listening to this, look, if you have an industry that you're really knowledgeable about, you've probably got as good a chance of estimating the earnings as the analysts, the sell-side analysts. So if you think that they're making stupid assumptions, either too high or too low on the company's revenue opportunity, that's where you should focus your energies.
Matt was saying regarding your academy class, do you offer courses? Is it aimed at novices, really?
So the Analyst Academy is a 12-month subscription program. So you pay each month, so you can stop at any time if you can't afford it, or you don't like it, or whatever. We offer a 30-day money-back guarantee. So if you sign up and you think, oh, this is too difficult, you can give up, and people do that. I mean, don't make any bones about it. What we do is, if you're a complete novice, we say, look, you need to do a few things before you start the course. So if you're a complete novice, we give you 2 additional courses that you don't need to do it, but we say, look, here's an introduction to accounts, here's an introduction to investing. Do those before you start. And we also say, if you're a complete novice, we recommend a book. So we give you this book. We don't give you, we give you the Amazon link to this book, which is a very good book. The problem with accounting is it's very technical, and most of the accounting books are written for accountants, and there are very few books that are written for non-accountants. There's a book that's written for non-accountants, and it explains basically the accounting concepts you need to understand. Then you can do our content, and that, you know, it makes it much easier. But have a look on the website, and if anybody's got any, you know, any questions, please email me, info@behindthebalancesheet.com.
Fantastic. Thank you, Stephen, to Ben for asking the question. Individual investors can't start with financial statements. This is from Sajid. How do you suggest we create the watch list for which we then look at financial statements? I think we might take a little bit too long to go into that as a question, Sajid. Maybe you can contact Stephen on the email. If you could info@behindthebalancesheet.com, and then we'd be happy to give you a fuller answer. Do you follow and rate city analysts, Stephen?
Do I rate city analysts? By and large, no. I mean, you know, almost all my friends have quit because the job has been really dumbed down. So, you know, in the old days, you had 50-year-olds, 60-year-olds, even 70-year-old in New York who had been following his industry for 20, 30, 40 years, knew the industry inside out, knew the management inside out, knew exactly what was going on, had a huge range of contacts, and they were really information rich. And they weren't always brilliant at telling you what the share price was going to do tomorrow, but they really understood what was going on in the business. And if you get that input, then it's very helpful in understanding where the shares are going. Today, I mean, one of my pals was head of research at one of the big bulge bracket firms in London, and he said it was a completely miserable job. He had 275 analysts he was responsible for, and when one of his good analysts left and said, you know, I've had enough of this, he sort of breathed a little sigh of relief. He could put somebody cheaper in the chair. You promote one of the junior people, and because his budget, the thing is, since MiFID II, since the fund managers are paying for the research themselves, they're spending less in research. So the banks have to spend less, you know, they're getting less money, so they're spending less, their costs are falling. And every year, the job is getting more juniorized. So, yeah, I mean, there are still a few of my friends doing it, but, you know, I don't let these young looks deceive you. I'm very old, and almost all my friends are retired.
Fantastic. Stephen, we're going to wrap it up there. We've run just a little bit over, and I appreciate you sticking to the time, though. It was really good. Fabulous presentation. Good to see you. Hopefully we can catch up again soon for a cheeky beer again when we meet. And
I'm hoping to be down that way soon.
Well, I look forward to it. As always, much appreciated. Everybody's saying thank you as well in the chat box here as well. So I will take the presenter role back from you.
Thanks for having me.
Thanks, Stephen.
Cheers.
Great, there we are. So thank you very much indeed, everybody. We're finished, we're done. It's been a really great 3 hours, and I hope you've enjoyed some of the analysis, some of the information, and look at the platforms. Hopefully we're leaving you a little bit better knowledgeable about where the stock market is now, which stocks are looking good, which ones are looking a bit shaky, and really that's what we set out to achieve today to do. Please do sign up to the UK share breaking game that Alpesh is running with Paul. A lot of people having lots of good fun and learning as they're doing it there, using the Stockomendation service to that. We will be doing some more events shortly as well. The recording, yes, Michael, is going to be available. You should be able to get an email of that. If not, I will be posting it onto our YouTube site, where you can access it there, youtube.com/IXinvestor. So thank you very much indeed, everybody, for joining. It's great to have your support. It's been my pleasure to host the event, and wish you a good night. We'll see you again soon. Many thanks.